Hello, good afternoon, and welcome to Unacademy IAS, a one stop destination for all the English medium civil services aspirants. Welcome to the final revision of the subject Indian economy for the upcoming prelims 2026. Now, before I start, please do let me know that I'm audible and visible for all of you. Those present in the session, please confirm am I audible and visible for all of you so that we can start the session. Great. Thanks a lot. Let's start. So, before I start the discussion, here's a very important announcement. In the last week, for the next 7 days, please practice as many mocks as possible. And to help you out, the Unacademy IAS is providing you 46 tests at a cost of just 1 rupee. And this is specifically applicable for those who are preparing for the upcoming prelims. Please enroll into the test series and practice as many mocks as possible for the next 1 week. This will help you in boosting your confidence, and second will also basically help you in revising and understanding if there are any concepts that you have missed. Now, second very important announcement is Monday and Tuesday at 4:30 p.m. Please note the time. Monday and Tuesday at 4:30 p.m. I'll be taking a special class on the Unacademy platform. And in these special classes, I'll be discussing MCQs, the current affairs MCQs. So every day, right, 2 days, right, we will have MCQs on the current affairs, a short session. Please do join. And to join, all you need to do is scan the QR code that are visible in the slide right now. Enroll for the session. Right, 2 days we'll solve the MCQs. Okay, now let me start the discussion. We will have a revision of the topics of Indian economy. I'll start with the most important topic, and over a period of time, we will keep on covering the least important topics as well. So, in order to help you, in order to ensure that the revision will be done very smoothly or peacefully, I've created the mind maps. I'll be using these particular mind maps to revise. Done? Now, somebody is asking how to basically enroll for the mock test. There is a link which has been provided in the description part of the video. You can use the link and enroll. Now, let me start. First and foremost, in the GS paper, specifically of the Indian economy, around 4 to 5 questions will come from the topic of RBI, that is banking sector. So let's focus on the most important topic, banking, that is specifically starting from Reserve Bank of India. And by the way, all of you, please confirm, is the mind map visible for all of you? Is the mind map visible for all of you? Please do confirm, and then I'll start the session. Great. Let's start. So, Reserve Bank of India, within the banking, Reserve Bank of India. Now, Reserve Bank of India, it was established after the passage of RBI Act of 1934. From the 1st April 1935, RBI started functioning. The Reserve Bank of India's most important function is to have the monetary policy, that is credit control policy. The monetary policy essentially have two components. One is called as a qualitative set of tools, and the second one is quantitative and qualitative set of tools. What is the fundamental difference between quantitative and qualitative? Qualitative, the money will be regulated and targeting specific sectors. The money regulation will happen targeting specific sectors. Whereas in case of quantitative, the overall money supply, in the economy can be regulated. Now, please focus on the discussion. Don't worry about the PDF. Focus on the discussion. So, quantitative, overall money supply, and qualitative, regulating money supply, targeting specific sectors. Now, in the quantitative, what are the different tools which are used by Reserve Bank of India? One is the open market operation, OMO. There are two types of open market operation, that is a temporary as well as outright. What do you mean by temporary? Under this OMO, the money supply will change, but for very short duration, maybe for 7 days, maybe for 14 days, etc. And the best example for temporary OMO are basically repo rate as well as reverse repo rate. Everybody is okay? Repo and reverse repo. Under repo, RBI will give short-term loan to a bank, charge a rate of interest. Under reverse repo, the banks will deposit money, collect the collateral, collect the security, and charge a rate of interest. Who decides repo rate as well as the reverse repo rate? It is the Reserve Bank of India. But when I say Reserve Bank of India, specifically the repo rate, it is decided by the Monetary Policy Committee. We will come to that later. So in temporary, the money supply changes for a very short duration. In case of, right, let's say the outright, in case of the outright, the money supply will be for a longer duration, that is permanent changes. RBI will simply purchase government bonds. So money supply will change permanently. RBI will sell government bonds, money supply will change permanently. Everybody is okay, right? So temporary, outright. This is open market operation. Then there is a standing deposit facility. Standing deposit facility, SDF. Under the standing deposit facility, the banks will deposit money, that is give money to RBI, and essentially take rate of interest from the Reserve Bank of India. But the speciality of the standing deposit facility is there is no usage of government security. There is absolutely no government bonds that are used or that are given by the Reserve Bank of India as a collateral. This is a very important distinction between reverse repo rate and, right, a standing deposit facility. Under STF, no collateral. Under reverse repo rate, there is a concept of a collateral. Let me move on now. Marginal standing facility. And before I go on to the MSF, the standing deposit facility was recommended by a committee. Please remember the name of the committee as well. Urjit Patel Committee. Urjit Patel Committee. Marginal standing facility. What is this idea of a marginal standing facility? The banks, if they want to borrow for a short duration, for example, overnight purposes, there is an emergency, there is a shortage of the funds, etc., they can deposit the government securities, borrow from Reserve Bank of India. That is the reason the Reserve Bank of India will impose a rate of interest which is higher than repo rate when the RBI will lend to these particular banks under marginal standing facility. And whenever you come across the term standing, what is the meaning? Whenever you come across the term standing, this facility is available throughout the year. This facility is available throughout the year. Please remember this as well. Then there is a cash reserve ratio, CRR, cash reserve ratio. Basically, the banks will collect deposits. All the deposits collected essentially are classified into net demand and time liabilities, NDTL. Now, percentage of the NDTL that the banks will have to keep with the Reserve Bank of India, on which RBI does not pay any rate of interest. This is called as cash reserve ratio. And the rate that is generally decided by RBI for cash reserve ratio is in the range of 3 to 15%. 3 to 15%. Right? And finally, right, next one, the statutory liquidity ratio. In the statutory liquidity ratio, that is SLR, percentage of the NDTL that are collected by the banks, they will have to keep with themselves, either in the form of cash or in the form of a gold or in the form of a government bond or approved securities. Who will decide what kind of securities will be covered under the SLR? It is decided by the Reserve Bank of India. Right? And please understand, here the focus will be on percentage of NDTL, both in case of CRR as well as SLR. Next one is bank rate. This is a final tool under the quantitative bank rate. Under the bank rate, Reserve Bank of India will give loans to the banks and charge a rate of interest. That is called as bank rate. Now, the fundamental difference between repo and bank rate is, in repo, there is a repurchasing order. There is a contract between the RBI as well as the bank to repurchase the assets which are sold in the first leg of the transaction. Whereas in case of bank rate, there is no contract. It is purely a lending rate. Reserve Bank of India will give a loan and charge a rate of interest. Charge a rate of interest under the bank rate. So these are some of the very important fundamental points associated with the concept of quantitative set of tools. Now, when you look at all of these particular tools, the overall money supply in the economy will either be increasing or will be decreasing. RBI will use these particular tools either to increase the overall money supply or decrease the overall money supply. Whereas if you talk about qualitative set of tools, now the Reserve Bank of India will use the qualitative set of tools to regulate money supply targeting specific sectors. For example, agriculture sector. For example, MSME loans, the startup loans, loans which are given to weaker sections of the society, gold loans, etc. All these kind of, let's say, sectors can be targeted using qualitative set of tools. For example, the first one, rationing of credit. What do you mean by rationing? Allocation of the credit. That is basically distribution of the credit. How can you control the distribution of the credit? By imposing a limitation on how much loans you can provide to some of the kinds of borrowers, some of the sectors, which belongs to the borrowers. For example, under the priority sector lending, PSL, under the priority sector lending, RBI will dictate 40% of the loans should be given to the following borrowers. There are 8 categories of borrowers. Memorize all of them. For example, there are MSME borrowers, weaker sections of the society, export credit, education loans, housing loans, etc. So that is priority sector lending. In addition to this, you have regulation of consumer credit. That is, Reserve Bank of India will direct the banks to regulate the flow of the credit for consumer loans. For example, you want to take a vehicle loan. You want to take, let's say other types of loans. That is a consumer loan. RBI can direct the banks to change the conditions. For example, it can direct the banks to change the conditions applicable for EMI, the amount of installments that you are paying, etc. So according to the requirement, either to promote growth or to control inflation, RBI can ask the banks to change these particular conditions so that the flow of the credit for consumer loans will be affected. Next, there is variation of margin requirements. What is a margin? Margin essentially means how much is the total value of the money, that is the asset value that you'll have to pay from your pocket. In addition to this, you take a loan. That is, let's say you are taking a home. The home value is 1 crore rupees. Bank will give you a loan of 70 lakh. 30 lakh you'll have to pay from your pocket. That is called as a margin. That is basically the concept of, let's say down payment. So if RBI will ask the banks to change the amount of the down payment, automatically how much loans you are able to take, that will also be affected. That is variation of margin requirements. Then there is moral suasion and direct action. Moral suasion means RBI warning the banks to follow through letters, through verbal warnings, directions, etc. The banks must follow the guidelines regarding the lending activity. If the banks do not follow even after the moral suasion, RBI will start penalizing these particular banks. That is called as direct action. Done? So this is a set, and expect a question from this particular set of tools that I've discussed just now. Qualitative and quantitative, expect a question. Now, what are the other important points regarding the Reserve Bank of India? It was recommended by Hilton Young Commission. Memorize this. It was set up with the passage of RBI Act of 1934. It is mainly driven, that is the policy making or the decision making authority under the Reserve Bank of India is the Central Board of Directors. The Central Board of Directors has a composition where there is one RBI governor, 4 deputy governors, 10, let's say appointed by the government. Then there are 4 representatives from, the regional offices or let's say the headquarters in 4 metro cities. Then there is, basically another one, that is the Economic Affairs Secretary and the Finance Secretary. So total composition of Central Board of Directors according to the law is 21. And basically this is the most important authority within the RBI to take policy decisions regarding RBI. What are the functions of Reserve Bank of India? What are the functions of Reserve Bank of India? 1, it is the banking regulator. Anything to do with the banking sector. For example, who should be allowed to work as a bank? That is banking license issuance. Whose license should be cancelled? What kind of operations you should be allowed to conduct, etc. All of those are regulated by Reserve Bank of India. Next, RBI is also referred to as a lender of last resort. The argument behind this is a bank, again I repeat this, a bank whenever it is in an emergency or in a crisis, it can always go to RBI, borrow from RBI. Hence, a lender of last resort. It is also banker to the government. It operates on the behalf of the government to collect government money, to pay government money, to borrow for the purposes of the government usage, etc. Hence called as banker to the government. It also plays a very important role in terms of currency management. The currency notes are printed by RBI. I'll discuss that as well. Currency notes except 1 rupee are printed by RBI. Currency coins are minted by Government of India. The distribution of the coins and notes is conducted by the Reserve Bank of India. Managing forex reserves, this is also very important. The forex reserves are held by Reserve Bank of India. And whenever there is a requirement of forex reserves in the in the forex market, there's a shortage of forex reserves, etc. The sale of official reserves is conducted by Reserve Bank of India. Right? Just now we have discussed the credit control policy or the monetary policy tools. And finally, another function of RBI is controlling inflation. Now, what is the importance of RBI in terms of controlling inflation? I'll just revise it. Please listen to me carefully. The Government of India as well as the Reserve Bank of India have signed an agreement, MPFA 2016, MPFA 2015, which has come into force from 2016. According to this, for 5-year duration, the Government of India, after consulting the Reserve Bank of India, will fix a inflation target. Right now, the inflation target that has been fixed is CPI headline 4%. It is the duty of the Reserve Bank of India to maintain the CPI inflation rate at 4%. What if the RBI fails to maintain it? Then it has to give a written explanation to Government of India. But there is a caveat. Caveat is RBI cannot always maintain 4% exactly. Flexibility is provided, that is 4% plus or minus 200 basis points. 4% plus or minus 200 basis points. That is a maximum. Ceiling level is 6%. The floor level is 2%. Now, in order to decide the interest rate, that is the repo rate, there is the MPC. There is a monetary policy committee which has been established according to section 45 of RBI Act of 1934. According to RBI Act of 1934. So, in this particular monetary policy committee, there are 6 members. Of the 6 members, 3 are from the Reserve Bank of India and the remaining 3 are the experts who are appointed by Government of India. They will generally have a tenure of 4 years. These are the important points. And the monetary policy committee takes a decision by majority, right? And that is the reason, because the 6 members are there, there could be a tie. In case of a tie, the RBI governor, who is the chairperson, who is the head of the monetary policy committee, will be given a casting vote. That is a right vote to break the deadlock. Done? Everybody is okay with the functions of Reserve Bank of India? Please do let me know. Next, important concept under banking, Basel guidelines. Important concept under banking, Basel guidelines. What are the important points regarding the Basel guidelines? First and foremost, Basel guidelines are issued by a committee which is known as Basel Committee on Banking Supervision. This is set up under the BIS, that is the Bank for International Settlements, and the BIS is located in Geneva, Switzerland. Please remember this. So there are 3 rounds of Basel guidelines which have been issued: Basel 1, Basel 2 and Basel 3. Basel 1 was issued in 1988, and before I go forward, these are the important points. Basel norms are not mandatory, right? Please understand, these are not mandatory, but the member countries basically follow them, right? And second, whatever Basel norms are announced, should the banks or the central banks follow exactly the same norms? The central banks are allowed flexibility. The central banks are allowed flexibility. That is, I can change certain norms according to the requirement of Indian economy. So far, 3 rounds of Basel guidelines have been announced, and all of these are applicable to the banking sector. Basel 1, 1988. Focus of the Basel 1 was capital adequacy ratio. That is, under Basel 1, they considered only one type of a risk, that is the credit risk. The focus was on credit risk. So the credit risk was considered. In order to absorb the losses, right, the banks should have the minimum capital, that is a capital adequacy ratio of 8% of risk-weighted assets. The Reserve Bank of India has changed it from 8%. In case of India, it is 9%. But please understand, 9% overall. For certain banks, for example, public sector banks, it is 12%. For payment banks, it is 15%. For scheduled commercial banks, it is 9% in India. Right? And what is the meaning of capital adequacy ratio? The minimum amount of capital that you are supposed to have to absorb the losses. What is the minimum amount of capital that you should have, that is the money that you should have to absorb the losses. So capital effectively will be of two types. I've given it at the last, please have a look at it. Capital effectively are of two types, tier 1 and tier 2. Tier 1 is called as core, tier 2 is called as supplementary. Tier 1 is more reliable. Tier 1 will absorb the losses much sooner compared to tier 2. Right, that is the reason the banks are asked to maintain more and more of tier 1 compared to tier 2. Right, so please remember all of this. Example, for tier 1 capital, please remember additional tier 1 bond, which was there in the newspaper very recently, or common equity tier. For supplementary capital, that is a tier 2 capital, remember tier 2 bonds. Tier 2 bonds, right? All these are important. Please remember all of this. So come back to Basel 2 now. Basel 2 was announced in 2004. Under this, rather than focusing on only one type of risk, the coverage was expanded to cover three types of risk. That is essentially, right, the risk because of the market fluctuation, that is market risk. The risk because of the systems, people, etc., that is operational or systemic risk. And the third one is the credit risk. That is when you give a loan, right, effectively the loans may not be given back to you, or you may not be able to recollect the loan. That is a credit risk. So instead of one risk, three risk. And that is the reason, right, the Basel II guidelines also expanded the coverage. We basically had three pillars under the Basel II. The three pillars are: one, capital requirements, that is a capital adequacy ratio. Second one is the supervisory review and the market discipline. Supervisory review simply means the banks will have to create systems in order to, right, basically reduce the impact of, right, the different types of risk that the banks are facing. And the market discipline simply means the banks which are implementing reforms will have to keep on reporting the data, keep on giving disclosures to the regulator. That is basically the market discipline. And the latest one is the Basel III. Under Basel III, which was announced in 2010, the focus is more on having, right, more of tier 1 capital, right, have more and more tier 1 capital compared to tier 2 capital. Have the concept of capital conservation buffer as well. That is in order to absorb the losses during, right, emergency situations. Have a buffer, that is a capital conservation buffer. And it also recommended that you should have a liquidity coverage ratio of at least 100%. In simple terms, have high quality liquid assets equivalent of 100% of the total money outflow for the next 30 days. That is basically the liquidity coverage ratio. So these are the important Basel guidelines. Can we go forward now? Now, what are the different types of banks? What are the different types of banks that you are supposed to know? Right, scheduled banks. These are basically, right, covered under the second schedule, registered under the second schedule of Reserve Bank of India Act of 1934, and they should have a minimum paid up capital of 5 lakh rupees. Minimum paid up capital of 5 lakh rupees. Right, these are the scheduled banks. And then there are non-scheduled banks. These are not registered under the RBI Act of 1934. We have public sector banks which are registered and majorly owned by the government of India. We have private sector banks, and these private sector banks can be the foreign private sector banks as well as the domestic private sector banks. But now comes the most important part within the types of the banks: RRBs, regional rural banks. These have been set up, and these have completed 50 years, by the way. These have completed 50 years. Please focus now. So RRBs were set up with the passage of RRB Act of 1976 based on Narsimham Committee recommendation. And right now, there is a consolidation drive which is being done by the government of India. They are merging all of these RRBs into one RRB in one state. And this particular policy has been in force from May 2025. One state, one RRB. Right? And the focus of RRBs essentially is rural as well as semi-urban areas. RRBs just work like any other bank, but the focus of RRBs is giving more and more loans under the priority sector lending. Next, urban cooperative banks. There is a system of cooperative banks. We have rural cooperative banks. We have urban cooperative banks. Okay, rural as well as urban. In case of rural, right, essentially there are three levels. At the lowest level, we have primary agriculture credit societies. Above that, we have district cooperative banks, and above that, we have state cooperative banks. In case of urban cooperative banks, right, we have the normal structure, that is a multi-state urban, rural, right, multi-state and right, the single state urban cooperative banks. In case of, let's say, right, the rural cooperative banks, again, there is one more structure. Please remember this. That is, if the cooperative banks are giving short-term as well as long-term loans. What I explained to you earlier was basically the institutions which will provide short-term loans to the borrowers. If it is a long-term loans, there are two levels again. The primary cooperative agriculture rural development bank and right state cooperative agriculture and a rural development bank. That is basically the distinction. Now, please focus on urban cooperative banks. These work just like any other bank. They will have to follow the PSL of 60%. We also have the payment banks, right? The payment banks are part of differentiated banking sector. The payment banks are allowed to collect deposits, but not more than 2 lakh rupee worth per customer. They are not allowed to give loans individually. They are not allowed to issue credit cards individually, etc. Now can act as a banking correspondent and offer value added services. These are allowed to work as a banking correspondent, basically provide banking services on behalf of some other bank in the rural areas. Now they are allowed to collect deposits not more than 2 lakh rupees per customer. The SLR that these particular payment banks will have to maintain is minimum 75%. Right? So these are important points associated with the payment banks. Now there is also a concept called as lead bank scheme. Lead bank scheme. This was there in the newspaper. RBI wants to revamp this. What is the basic idea of a lead bank scheme? In a district, one bank will be identified as a lead bank. It will basically conduct the cooperation and coordination activities amongst all the stakeholders. So lead bank scheme was announced back in the year 1969. It focuses on area approach, right? The recommendations regarding the lead bank has been provided by Narsimham Committee as well as Gadgil Study Group. And the focus here is district-wise, there will be a lead bank appointed. District-wise, there will be a lead bank appointed. Done? Okay, what are the other types of banks? Small Finance Bank, SFB. It is a type of a differentiated bank. It is one more type of a differentiated bank. Small finance banks will have to have a minimum paid up capital of 200 crore. In case of payment banks, 100 crore. Small finance bank, 200 crore. These will focus on underserved and unserved borrower. For example, MSMEs. For example, small and marginal farmers, etc., etc. Done? Right? So, these will provide loans just like any other banks. Right? Loans in the sense, they will target, PSL target will be there, higher target will be there for SFBs. But these will also function just like any other normal bank. Right? So, next one is development banks. Please go through these particular the development banks or development finance institutions. There are 4 types of development institutions: NABFID, NABARD, SIDBI and EXIM. And if you have not yet seen, I've made a video on all of these development organizations. Please go through that. Please go through that. I've already given the PPT as well. At least go through the important points. Okay, right. One more very important area is local area banks. Right. One more important area, right, is local area banks. That is, LAB scheme was announced in 1996. It has been set up under Section 2022. Right. It is also covered under Banking Regulation Act. And the focus of local area banks is right on 2 or 3 districts. Okay, done. Now, somebody is saying please focus only on the important areas. My dear, as far as I'm concerned, I'm focusing only on the important areas. I'm focusing only on the important areas. Right? Anyways, what are the different types of lending rate regimes available right now? Lending rates that are there right now. Right, the 2 most important lending rate regimes that you should focus and go through is, one is external benchmarking, which has come into force from 2019, and the other one is MCLR that has come into force from 2016. One is from 2019 and the other one is from 2016. Before this, there were different types of lending rates. These 2 are the most important ones for you. Right, so MCLR, under this, the focus is on the banks determining their lending rate based on certain parameters which have been recommended by RBI. The parameters which are used are, for example, the cost of the funds. Right? Apart from this, there is negative carry on the CRR. Apart from this, there is operational expenditure. the, right, let's say the long-term funds or the long-term loans which will carry higher risk, they should have a higher premium. So these kind of parameters are used by the banks themselves will decide the lending rate. But from 2019, there is a new system which has come into place. From 2019, there is a new system which has come into place, that is external benchmarking. This was recommended by Janak Raj Committee. Janak Raj Committee recommended that the lending rates of the banks should be connected to an external parameter, right? And that's the reason the banks generally, I repeat, generally now connect your lending rates to, right, let's say repo rate. And when the repo rate changes, your lending rate will also automatically change. This is basically the concept of external benchmarking which has come into force with the recommendation of Janak Raj Committee. Now, one more very important area within banking is ATMs. ATMs, automated teller machines. Right? Fundamentally, there are two types, right, that you need to remember: brown label and white label ATMs. Brown label and white label ATMs. The brown label ATMs are operated and maintained by a third party. That is, the bank will allow somebody else to maintain, operate an ATM. And for maintaining and operating this particular ATM, the bank will pay certain premium amount or certain charges to, right, the entity. And these particular ATMs will display the logo of the sponsor bank. Sponsor bank essentially means the bank, right, which has allowed this party to operate the ATM. These are called as brown label ATMs. Then there is white label ATM as well. In the white label ATM, the banks are not involved in the operations. Everything is conducted, I repeat, everything is performed by a third party. Third party means, let's say, a non-banking financial company. They will operate these ATMs. They will refill the money. They will bring the ATM machines, etc. Everything is done by a company, a separate company altogether. The banks, whenever these ATMs are used, the banks will have to pay certain money to the ATM operator. And these white label ATMs will display the logo of the entity which is operating them. So these are the two very important types of ATM machines. Please remember both of them. Can we go forward now? Now, different types of money. Within the banking sector, focus on the different types of money as well. Right? So money, one is commodity money. That is, a commodity such as gold, silver, shells, beads, etc. is used as money. After that, we have fiat money. That is, through the order of the government, this money is issued in the market. That is, the currency coins and the currency notes that we are using right now. In addition to this, we also have fiduciary money. This is the kind of money which is accepted in the market by the seller based on the confidence of the seller. For example, the checks. If I want to pay, right, let's say the money to you in the form of a check, whether you accept or not is dependent on the confidence that you have on me. That is basically the concept of a fiduciary money. And then there is a fourth type of money, commercial bank money. This is essentially the money that is created by the banking sector after collecting the deposits and by giving loans. This is basically that kind of a money that is created by the banking sector. This is called as, right, a commercial bank money. Then everybody is okay? Now, most important within this is fiat money. Fiat money. The currency coins that we are using, currency notes that we are using. For example, have a look at this. The currency notes and the currency coins, the printing is done by the Reserve Bank of India, and these are the places where the printing is done. Please memorize all of these. Please memorize all of this. Devas, Mysore, Nashik and Salbani. These are the four places where the printing of the currency note is done. The Reserve Bank of India will conduct the printing except 1 rupee note. Right? And the minting of the coins is undertaken by the Government of India. The minting is done at Noida, Mumbai, Hyderabad and Kolkata. When I say 1 rupee note, 1 rupee note is not counted as a part of a currency note. It is counted as a currency coin. Please remember this. Please remember this. Okay. Now, there is also a concept of CBDC, Central Bank Digital Currency. Who will issue this? Reserve Bank of India. Is it a legal tender? Yes. Right, basically it is a digital form of, right, the fiat money. Digital form of the fiat money. It will be a legal tender. Okay. Now, next, Important area, monetary aggregates. Next important area, monetary aggregates or money aggregates, money multiplier aggregates. There are five types. There are five types: M0, M1, M2, M3 and M4. M0, M1, M2, M3 and M4. Please memorize all the five. M0 represents the liability of the Reserve Bank of India. Liability of the Reserve Bank of India. There are other names for M0, monetary base or high powered money. Right? The composition of M0 is the currency in circulation. That is whatever currency has been distributed by RBI. It could be coins, it could be currency notes. So currency in circulation plus banks deposits with Reserve Bank of India plus other deposits. For example, another central bank has kept money with RBI. Another government has kept money with RBI. All these are counted as a part of M0. Now using M0, that is a currency in circulation, RBI will issue currency in the market. Now out of this particular currency, some of the money that is held in the form of a cash with the public will be counted as currency held by the public plus demand deposits in the banking sector plus other deposits with RBI. Why is this important? You have M0, M1, M2, M3 and M4. M1 and M2 are generally considered to be narrow money. Narrow money is that kind of a money which has very high liquidity. Right? M4, M3 and M4 has very less liquidity. Please remember, they can ask you to arrange them in terms of liquidity. M1 has very high liquidity, M4 has very less liquidity. Right? So that is the reason the cash that is there with the public, the demand deposits that are held by the public with the banks, etc., will be counted as a part of the M1. Now M2, you have M1, please take it, and to M1 add post office savings deposits. Why do we add the post office savings deposits separately? Post office savings accounts are less liquid compared to the bank deposits, that is demand deposits, and are more liquid compared to the time deposits in the banking sector. That's the reason. So M1 and then M2. You have M3. M3 is basically take M1 as it is and add, right? Add time deposits with the banking sector. Add the time deposits in the banking sector. And finally, you have M4. M4 will be M3 plus all the deposits which are held with the post offices except the national savings certificates. So these are the four aggregates. Now using this, they will also calculate money multiplier. Money multiplier. Money multiplier will be equivalent to M3 upon M0. Remember this. Money multiplier basically means what is the maximum amount of money that will be added to the supply. Right? That can be changed in the overall money supply by changing the monetary base. This is called as a money multiplier. Everybody is okay with these particular four indicators, right? That is M1, M2, M3 and M4. Okay. Now, right, the last part of the banking sector, payment systems. You have NEFT, you have RTGS, IMPS and UPI. Please go through all of them. NEFT is National Electronic Fund Transfer. This is operated by Reserve Bank of India. It is available throughout the day, right? It is available throughout the day now. And the settlement is done under NEFT in batches. That is, when you transfer money using NEFT, the transfer doesn't happen immediately. Right? Transfer doesn't happen immediately. It will take some time. Every half an hour, the transactions are cleared. That is, right, the transfer happening in batches. And the amount of money that you want to transfer under NEFT, there is no minimum limit. There is no maximum limit. Next, RTGS, real-time gross settlement. Under RTGS, the settlement of the money will happen in real time, but the minimum amount of money that you want to transfer under RTGS has to be 2 lakh rupees. Minimum 2 lakh rupees. Right? And that is the reason there are certain charges imposed by the bank whenever, right, you want to transfer funds through RTGS. Settlement is real time. It is available 24/7 and RTGS is also operated by RBI. Third one, IMPS. IMPS stands for Immediate Payment Services. It is operated by NPCI. Please be very careful. It is available throughout the day, right? That is 24/7. And the settlement under IMPS will also happen in real time. And finally, you also have UPI. UPI is operated by NPCI. Settlement is done in real time. It is available 24/7, and UPI is mainly used for day-to-day transfers of money. Right? Everybody is okay? Now, these are the things I wanted to cover in the context of banking sector. Right? Banking sector. Right? Please do not worry about the PDF or the PPT. Please focus on the revision. Then I'll tell you something about PPT as well. Please don't focus on that right now. Now let me move on to the next chapter, financial market. Important. RBI is the most important. After that, financial market. Financial market. What are the important points within the financial market? Financial market is divided into two parts: money market and capital market. What is the difference between money market and capital market? Money market has transactions, that is the instruments, which will have lesser maturity period, that is less than 1 year. The capital market will include the instruments which will have more than 1 year maturity period. Under money market, the money is generally raised for working capital purposes. Under capital market, the money is raised for creation of assets. Money market mainly, I repeat, mainly is regulated by Reserve Bank of India. Capital market mainly is regulated by SEBI, Securities Exchange Board of India. Now, within the money market, there are different types of instruments. What are the different types of instruments? You have repo, reverse repo. We have covered some time ago, by the way, right? Collateralized borrowings and lending obligations, CBLO. Earlier it was there, today it is not there, but anyways. What is CBLO? Financial institutions which are holding the government bonds will be lending these particular will be lending money and collecting bonds. Is it okay? Financial institutions. So two financial institutions, basically one institution will lend and another institution will borrow, but fundamentally they'll be using the collateral of government bonds here. This is called as CBLO. Earlier it was there. Today it has been discontinued, and in the place of CBLO, we have introduced TREPS. What is the TREPS here? TREPS basically stands for the tri-party repo transactions. Tri-party repo transactions. What is the idea for tri-party? Tri-party means there are three parties involved in the transaction. What is the importance of this? Imagine there is one institution, right? Let's say a pension company and let's say one bank. They are involved in, right, the CBLO. There is always a counterparty risk. What is the meaning of a counterparty risk? What if one party does not abide by the terms and conditions of the agreement? Simple. Counterparty risk. Right? That is, one party will simply say, I will not settle the transaction. I will not abide by the terms and conditions. So that is the reason we have TREPS now. Under TREPS, what we have done, essentially introduced, right, the third party, that is, there is a clearing corporation. For example, there is clearing corporation by the name of CCIL, Clearing Corporation of India Limited. So there is a third party that is involved, which will guarantee the settlement of the transaction. Hence, this is called as a TREPS. Everybody is okay with the TREPS now? Next one is call money market. Call money market. What is call money market? One bank borrowing from another bank for a short duration. Right? One bank and another bank basically, right, will lend to another bank and borrow for short duration. Is everybody okay with this? For example, let's say there is bank 1. The bank 1 has shortage of money. It will borrow from another bank for short duration. How short? It could be for overnight purposes. It could be for up to 14 days purposes. If it is borrowed for overnight, this is called as a call money. If it is borrowed for more than 1 day and up to 14 days, this is called as notice money. Is it okay with everybody? Right? This is basically the concept of a call money market. Right? So the rate of interest that is charged under the call money market is called as call money rate. And right, please remember, the call money rate is influenced by multiple factors as well. For example, how much is the demand for the money? Do the banks have shortage? Do the banks have liquidity surplus or liquidity deficit, etc.? What is the repo rate? All these particular factors will keep on interacting with each other, will keep on influencing and determining the call money market in the financial market. So second one is right. So third one is call money market. Fourth one is commercial bills, CBs, commercial bills. Right. Basically, when the bills, right, let's say when there is a buying and selling, right, these kind of instruments are drawn by the seller. That is, I've sold certain goods to you. You will promise me that you will make a payment after 45 days. So I will draw the instrument, I will write the bill, and you will sign and you will put the seal of your company promising that you will make the payment after 45 days. This is basically called as a commercial bill. Right? So in case of emergency, imagine I have the bill with me. You will make a payment after 45 days, but after 15 days, I need the money. In such cases, is there any option for me to transact it or sell it in the market and get the money? Yes. In case of emergency, the seller is allowed to transfer these particular bills to somebody else in the market and get money from the market. For example, all of you have come across the concept of trades, right? Come across the concept of trades. Trades will basically facilitate, right, all of this. Next is a commercial papers. Commercial papers are again short-term instruments which are issued by very highly rated companies. Very highly rated companies. So the high rated companies will issue these particular commercial papers, borrow from the market. And this is basically to fill up the shortage of working capital. To basically fill the working capital. Right? So these are again transferable. Transferable in the sense what? These can be transferred from one holder to another in the market. Then there is a certificate of deposit. Certificate of deposit. These are again the short-term instruments which are issued by financial institutions. For example, banks. For example, development banks, etc. Right? So these are again transferable. So whenever the banks are facing, let's say, short-term funds, the development banks, right, are facing short-term, right, liquidity crunch. In such cases, they are allowed to issue these kind of certificates of deposits. And I'll give you one more concept associated with all of this. Just give me a minute. I've summarized it on the left side. You can see it. Finally, the treasury bills. Treasury bills are type of government securities. The government, I'm talking about the center now. Central government is allowed to issue different types of securities. One type is short-term. These are treasury bills, which will have a maturity period of up to 1 year. Then there are government bonds or dated securities, which will have a maturity period of more than 1 year. Maximum maturity period of a government bond is 50 years now. So government is also allowed to issue these kind of instruments and borrow from the market. Now somebody was asking, sir, can we use the term negotiable instruments, promissory notes, etc.? This is the compilation of the money market instruments. Please go through this. That is, there are certain instruments which are issued at a discount and later are redeemed at par. There are certain instruments which are issued at a discount and redeemed at par. Right? These instruments are treasury bills. TB is a treasury bills here, not tuberculosis. TB is treasury bills. Second one is the commercial papers. And the third one is certificate of deposit. Can everybody understand? And I've used the same acronyms, that's the short form, when I've given these particular points right at the end. TB, certificate of deposit, commercial papers. Done. So these particular instruments are issued at face value. Issued at a discount and redeemed after maturity. You will get the face value. That is a basic idea. And there is also a concept called as a negotiable instruments. Negotiable means these can be transferred. These can be traded. These are negotiable instruments. So what are the types of negotiable instruments? Certificates of deposits are negotiable instruments. The commercial papers are negotiable instruments. The trade bills, right? Treasury bills are negotiable instruments. Commercial bills, which are also called as the trade bill, are negotiable instruments. Right? Everybody is okay? Please go through this particular summation as well. UPSC can ask you this kind of a question. So this is basically the sum of the money market that you're supposed to know. Now there is capital market. Capital market essentially means what? Where the instruments will have more than 1 year maturity period. Now there is two divisions under the capital market. One is the debt market, where debt instruments are issued. Borrowings will happen. Second one is the equity market, where shares are sold, that is the ownership instruments are issued. Right? So what are the different types of debt instruments? We have bonds. Bonds can be issued by the government. Bonds can be issued by the state government as well. Bonds are issued by the private sector companies, and these are also issued by global organizations. Right? So bonds can be issued by multiple authorities like this. But for sake of simplicity, have a look at this. The bonds are nothing but debt instruments, and bonds, right, basically can be convertible in nature. Convertible means one classification I'm saying. If these bonds are convertible, then these can be converted into, right, let's say equity, convertible bonds. The bonds can be non-convertible, that is the government of India's bonds are non-convertible in nature. Right? The bonds can be zero coupon as well. That is, these are the bonds which are issued at a discount, and after maturity period, you will get the face value of the bonds. And the bonds can be indexed as well. For example, Government of India earlier had issued inflation indexed bonds, where, right, the inflation indexed, the bonds value was indexed to the inflation rate. As the inflation would change, the value of the bond, that is the principal, interest, etc., would be indexed, adjusted with the change in the inflation rate. So these are the different types of bonds, traditionally the different types of bonds. But in addition to the bond market, there is also equity market. Under capital market, there is also equity market. Equity essentially represents shares, and the shares represent units of ownership. Shares represent units of ownership. Right? So shares, there are fundamentally two types of shares. Please have a look at this. One is called as a preference share, and the second one is equity share. Preference shares, these shareholders are given the first access for dividend distribution. When the company wants to distribute, the preference shareholders are given the first preference. Dividend is given to them first, and then equity shareholders. But there are pros and cons as well. The equity shareholders will have the right to vote. Dividend shareholders do not have the right to vote. Equity shareholders, the amount of dividend that they earn can be variable. One year you might get 4, another year 10 rupees, etc. But the preference shareholders will get fixed amount of dividend every year. Fixed amount of dividend every year. Right? These are the two types of shares, preference shares as well as equity shares. Everybody is okay? And some of you are asking questions. Are the bonds tradable? My dear, yes, most of the bonds are tradable. But please understand, Government of India sometimes might issue certain types of bonds, which government will simply say these are not tradable, these are not marketable. But generally, yes, bonds are tradable. There could be certain types of bonds which are non-tradable. And second important point, central government is allowed to issue treasury bills as well as government bonds. State governments are not allowed to issue treasury bills. These are allowed to issue only bonds. These are allowed to issue only bonds. And that is basically the state development loans. SDL, state development loans. Done? Okay. Now, right, there are two terms, IPO and FPO. IPO and FPO. IPO stands for initial public offering, where the companies are issuing the shares for the first time ever to the public. Second one is FPO. After IPO, if the company wants to issue in further rounds, right, they can go for issuance of the share, that is called as FPO. Right, there are two types of indices. I have my bet on these two indices this year. I'll tell you the reason why. Right, NSE, National Stock Exchange, established in 1992. The base year for the calculation of NSE is 1995, and the NSE includes the market capitalization, of course, free float market capitalization of 50 stocks. Whereas the BSE, the oldest stock exchange in India, the Bombay Stock Exchange, right, considers the market capitalization of 30 stocks, and the base year for the calculation of BSE is 1979. Right, these particular indices, right, they are completing 25 years, 30 years, etc. So be aware of all of this. Questions can be asked in the prelims examination. Okay, next important area, SEBI. Important regulator, SEBI. Securities Exchange Board of India. It was set up back in the year 1988. But later in 1992, it was given a statutory status. It was given a statutory status, that is SEBI Act was passed, and we have a statutory status. Right? It has a composition of 9 members. Memorize this. And the headquarters of SEBI is located in Mumbai. Okay. Now, certain important areas where UPSC has been asking questions, very, very niche areas. There's a term called as primary dealers. Right? Be very careful. There's a term called as, right, the primary dealers. Right? What is this idea for primary dealers? These are certain financial institutions which are licensed by RBI, which are given the approval by Reserve Bank of India. And these primary dealers, for example, banks, for example, many of these other financial institutions, these are authorized by the Reserve Bank of India to participate in the government security market. These are authorized to participate in the government security market. These are called as primary dealers. Please remember this. Right? Sometimes UPSC has the habit of asking these kind of niche statements. There is also, right, a concept of alternative investment funds. One is the traditional investment. For example, you invest in stock market. You invest in, right, savings accounts. You invest in FDs. You invest in bonds, etc. These are traditional investments. But apart from the traditional investments, there are alternative investments as well. These are collectively called as AIFs. These are collectively called as AIFs, Alternative Investment Funds. These are regulated by SEBI. Please remember, AIFs are regulated by SEBI. AIFs are categorized into 3, right? These are category 1, category 2, and category 3. And this was there very recently in the newspapers as well. That is connected to social stock exchange. SEBI has given, right, or SEBI has relaxed certain norms applicable to the investment of retail investors in the category 1 of alternative investment funds. The threshold amount has been reduced to promote the participation of retail investors. So there are 3 categories, 1, 2, and 3. Example of category 1 are social venture funds. Category 2, right, the private equity funds, etc. And the category 3 example is hedge funds. All the 3 come under the regulation of SEBI, Securities Exchange Board of India. And the concept is very simple. The money is pooled and the pooled money is invested in the market. This alternative, right, type of investment vehicle is called as alternative investment funds. Last concept after this, a bigger complicated area, MII, Market Infrastructure Institutions. Market Infrastructure Institutions. What are these market infrastructure institutions? These are essentially the types of financial institutions that will ensure that the market will operate on day-to-day basis. Right? These are the institutions which will ensure that whatever support is required for the market to operate, whatever transactions need to be conducted, whatever settlement needs to happen, etc. These MIIs will ensure the market will operate, right, let's say, efficiently or smoothly on day-to-day basis. These are called as market infrastructure institutions, regulated again by SEBI. Now, institutions or facilities which will help in conducting the day-to-day operations of the market, that is a financial market. Examples of MIIs are exchange, right? Let's say stock exchanges. Example, clearing corporation of India, etc. Right? Depositories, there is a CDSL, there is a NSDL, all these depositories. So these are the examples of market infrastructure institutions. Done? Everybody is okay? Do let me know. Can I move on now? Now I said next or the last concept under the financial market is slightly complicated, but I'll try to simplify this, right? And very quickly we'll have a look at all the important points. I want to discuss, in short, derivatives. In short, I want to discuss the concept of derivatives. A lot of you would have come across the term derivatives. Please don't overcomplicate it. Let's keep it very simple. What's the meaning of a derivative? Derivative is a contract. Derivative is a contract. Contract between two parties. Contract regarding what? Contract regarding an asset. In the derivative, there is a contract that is signed between two parties where one party will promise, or let's say one party and the second party will basically arrive at an agreement regarding one asset on a future date at what price it will be sold and bought. Is it okay? At what price it will be, right, sold and bought. That is the concept of a derivative. Derivatives are defined under Securities Contracts Regulation Act. Please remember that as well. Derivatives are, right, covered under Securities Contracts Regulation Act of 1956 as well. How many types of derivatives are there? Multiple types. Let's focus only on 4. But fundamentally, you can divide the derivatives into 2 types. One is standardized derivatives, where very strict regulation is there, right? There is a counterparty risk, right, issue which is addressed, etc., where regulator is, right, very much focused, etc. These are essentially the futures and options. F and O. F and O's, right, are the kind of derivatives which are, right, let's say the types of the market traded derivatives. Market traded, that is in the market, these are traded. But in addition to the market traded derivatives, there is also OTC derivatives. OTC means over the counter. Over the counter means the two parties individually are negotiating with each other. The two parties are forming the contract according to their requirement, etc. Whereas the, right, let's say the exchange traded, F&O, standard contracts. OTC, individual, right, according to the requirements. Everybody is okay? Now let's look at the forwards. Right, forwards basically are the type of derivatives where there is agreement between two parties to buy or sell an asset on a future date at a price decided today. We will agree to basically sell and buy, right, on a future date at a price that is decided today. This is called as a forwards. But please understand, we are forming this particular contract outside the market. Outside the market in the sense, according to our requirement. Right, basically we are forming this particular contract. Right? This is negotiated privately. And because there is no third party involved, there is no authority which will ensure that the contract is, right, let's say enforced. There is no authority which will ensure that, right, both the parties will abide by the terms and condition. There is always a counterparty risk. There is always a counterparty risk. So there is a huge counterparty risk in case of OTC derivatives. In case of OTC derivatives. Done? Then there is a futures. Futures is exchange traded. Futures is exchange traded. That is, two parties will agree and come into a contract. But please understand, this contract is standardized. There is no counterparty risk here. There is, right, let's say an authority, for example, clearing corporation, which will basically collect margins from the participants. The margins from the participants, which will ensure that if one party will basically not abide by, the margins are squared off on day-to-day basis. Right? So these are highly regulated. These are standardized. Counterparty risk is not there in case of futures. Done? Then there is options as well. In case of options, please understand, you buy an option. You buy an option. And this particular option will give you right. I'll repeat the statement. You buy an option. This option will give you a right. It's not an obligation. It will give you a right. Right of what? A right, either you want to sell the asset or a right that you want to purchase the assets. Is the term okay? Options. Option means by default, option means, right, other opportunities. So under options, you buy this option contract. This will give you an option either to sell the asset, not an obligation, just an option, or to buy the asset on a date. Right? So this is giving you an option, not an obligation. This is basically the concept of options. And whenever you want to buy these particular options, you will have to pay certain amount of money to get this option. This is called as a premium. It is called as a premium. Right? And please understand, you have bought an option, but the one who has issued the option, that person, that is the seller of the option or the writer of the option, doesn't have an option. Whenever the option is enforced, the second party, that is the seller or the writer of the option, has to abide by this. So the holder of the option has the right, but the seller of the option, that is the writer of the option, doesn't have any options. There is, right, mandatory enforcement there. Everybody is okay? Right? So these are certain important points. And when you say call option, there's a term call option. Call means you're buying. Call means you're buying. Sell means, there is a call and there is put. Call means you're buying, right? You have the right to buy. And a sell means you have the right to sell. Call option as well as put option. Done. And the last part of the derivative market, swaps. Last part, swaps. Swaps means what? Again, these are the mainly types of OTC, by the way, over the counter. The swaps essentially are contracts between two parties where the parties are agreeing, right, to exchange or cash flow or financial obligations in the future. I'll repeat the statement here. The two parties are agreeing, right? In the future, the two parties are agreeing today that in the future, they will exchange the financial obligations. They will exchange the cash flows. Right? There are different types of swaps. For example, we have a credit default swap, CDS. All these terms are there in the newspaper, by the way. Right? You have a total return swap. Very recently, RBI has issued guidelines regarding total return swaps. Right? You have interest rate swap, etc. Right? So these kind of swaps are essentially used to hedge the risk. Hedge a risk. But does it mean, right, there is no speculation in the swap market? There is a lot of speculation overall in the derivative market as well. Done? Everyone is okay? So this is the end of the financial market. Can we move on to the next one now? Important area. Can we move on to the next one? Do let me know. Please reply. Those who are present, give the confirmation that you people are not sleeping, by the way. Great. Let's continue. Right. So next is agriculture sector. We have covered banking. Right. Let's say we have covered financial market. Again, I'm saying I'm going in sequence of importance. Okay. Next, agriculture sector. In agriculture sector, let's start with the most important one, MSP, minimum support price. My dear, let's not take a break now. Right. Let's continue. Right, it's a practice for you to sit with attention that you need to do in the UPSC examination as well. Okay, let's continue. Minimum support price. First and foremost, minimum support price doesn't have a legal backing. Please remember, no legal backing means there is no law which mandates that the government should announce or must announce MSP. That has been the demand of the farmers. Point number one. Point number two, minimum support price represents the price that will be paid by the government to the farmers when the government will procure food grains from the farmers. Whatever could be the market price could be higher or lower, doesn't matter. This is the price paid by the government. MSP is decided and announced by the Cabinet Committee on Economic Affairs. MSP is decided and announced by the Cabinet Committee on Economic Affairs, but the recommendation regarding this is given by the Commission for Agriculture Cost and Prices. CACP recommends, and the CACP recommends based on certain factors. For example, CACP will consider what is the total demand, what is the total production, what is the cost of the input, additional 50% returns to be given to the farmers. What is the difference between cost of production between one crop with another crop, etc. So Cabinet Committee on Economic Affairs decides, but the CACP recommends taking into consideration these factors, and the CACP functions under Ministry of Agriculture. It functions under Ministry of Agriculture. Right now, the MSP is announced for 22 crops, and these 22 crops, I've given the list, that is the, right, let's say overall, not the complete list, but the different crops. We have 7 cereals, 5 pulses, 7 oilseeds, 4 commercial crops as well. And one such commercial crop, that is a sugarcane. For sugarcane, the MSP is not announced, rather FRP is announced. FRP, fair and remunerative price, is announced. And one more very important point here, the center announces MSP, states announce bonus. And when the farmer will sell, the farmer will get MSP plus bonus. But in case of sugarcane, the center announces MSP. The states announce the state advisory price, SAP, state advisory price. Whichever is greater, generally SAP is greater, that is given to the farmer. This is in the context of sugarcane. Done? right? So the price that is generally announced right now, the MSP that is announced right now is 150% of A2 plus FL, right? A2 plus FL. There are different types of cost of production. There is A2, there is A2 plus FL, and there is C2. There is a committee, please remember the name of the committee as well, right? MS Swaminathan committee. The MS Swaminathan committee has recommended that it has recommended that MSP should be announced on C2, but the government of India has changed it to A2 plus FL. 150% of A2 plus FL. Done. So these are certain important points in the context of MSP. Next, important concept, National Food Security Act. What are the important points under the National Food Security Act? NFSA 2013 has come into force. Under this, the government provides legal guarantee. Legal guarantees to distribute food grains. That is, the beneficiary covered under this has a legal guarantee from the government. Government will provide food grains under NFSA. Now, before NFSA, there were different types of, right, let's say programs in India. We had, initially to begin with, we had the public distribution system that was universal in nature. And after 1990, it was shifted to revamped public distribution system, where focus was done on the backward lying areas. Then, right, it was again changed. And finally, under NFSA 2013, we implemented the the measure of targeted public distribution system, TPDS. It was introduced earlier, but under NFSA, it is again targeted public distribution system. Under this, the government covers, right, they will target and cover the total two-thirds of India's population. Two-thirds of India's population, right? So two-thirds of India's population is covered under this. From the urban areas, 50% of the population is covered, and from rural areas, 75% of the population. And when I say of the population, it is the 2011 census population. 2011 census population. Under the NFSA, there are two types of beneficiaries. One is the priority households, PHH. The priority household beneficiary will be given 5 kgs of food grains per month. 5 kgs of food grains per person per month. There is a second category of beneficiary, Antyodaya card holders or Antyodaya households, where for a household, 35 kgs of food grains are issued. 35 kgs per household for Antyodaya, priority 5 kgs of food grains. When it was introduced, that is NFSA was introduced, please remember, for rice, the issue price was 3 rupees per kg. For wheat, the issue price was 2 rupees per kg. And coarse grains, the issue price was 1 rupee per kg. Right now, these issue prices have been reduced to 0 rupees. Till 28, the issue price has been reduced to 0 rupees, which means whether you are priority household beneficiary or Antyodaya, the government will continue to provide you 5 kgs of food grains. If you are PHH, Antyodaya 35 kgs, but at 0 rupees. But at 0 rupees. Okay. Now, what if you have a complaint? You have a grievance against, right, let's say, the implementation of the policy. In case of a grievance, you can file the complaint at the district level, DGRO, and after that, you can file a complaint at the state level, SGRO, State Grievance Redressal Officer and District Grievance Redressal Officer. Right, an important point, please remember this, the states under this will be identifying the beneficiaries, not the central government. Central government will allocate the funds. The central government will decide the quota. Quota means what? How many beneficiaries, how many, that is number wise, how many beneficiaries will be there in each of the state. But who is the beneficiary? That is, right, basically decided by the state government. Right, quota is decided by the center. Who is the beneficiary? Identification is done by the states. Right, so these are certain important points regarding NFSA. Now, associated with NFSA, there is a policy, please remember this as well. One nation, one ration card. One nation, one ration card. ONORC. One nation, one ration card. What is the importance of one nation, one ration card? Under ONORC, right, it will basically facilitate ration card portability. Ration card portability. For example, If you are a ration card holder, you are identified as a beneficiary in the state 1. But if you move to the second state, if you move to the third state, if you migrate to some other state, you may not get access to the benefits, that is 5 kgs of food grains. Now in that case, the center simply says, we will facilitate ration card portability. That is, you go to the nearest ration shop, provide your Aadhaar authentication. We will identify you as a beneficiary. We will continue to provide you your entitlement. So there are two systems to record the transaction. Please remember this. One is integrated management of public distribution system, IMPDS, integrated management of public distribution system. This will record all the interstate transactions. And the second one is Anna Vitran portal. This will record all the intrastate transaction. And this particular policy is being implemented by Department of Food and Public Distribution. Please remember this also. That is under the Ministry of Consumer Affairs, Department of Food and Public Distribution. Right? So very important points. Please remember. Now next, there is a law called as APMC. This is there in the newspaper very often. APMC. Agriculture Produce Market Committee. Right? What is the basic idea of APMC? The trading of agriculture commodities, buying and selling of agriculture commodities. The APMC law is framed by respective state governments. The APMC laws are framed by respective state governments. Reason behind this is intrastate. Intrastate comes under the state government power. Interstate comes under the central government. So state governments will individually formulate the APMC laws. Under APMC law, they will identify the food grains or the crops, etc. And these particular crops, the first sale of this, that is the farmer has to sell it only in this particular market. I'm using the term market. You will come across the term mandi. Is it okay? You will come across the term mandi. So the first sale of this crop has to be done in the mandi itself. So the state governments will formulate the laws. Some of the states have already abolished the laws. For example, in many of the northeastern states, you will not find it. In Bihar, you will not find it. In Kerala, you will not find it. Now Keralam, by the way. Okay. So state law, notified products will have to be sold through the market. And the object is very simple. The market will facilitate transparency. Market will facilitate better trading, better price discovery, etc. Now, associated with the APMC, there is one more concept, ENAM, Electronic National Agriculture Market. Electronic National Agriculture Market. Right? Electronic National Agriculture Market is essentially a portal which has been set up by the Government of India. The authority which has been made the nodal authority for its implementation is Small Farmers Agribusiness Consortium. This authority will ensure the portal is effectively implemented. What is done under this? The APMC mandis across the states are integrated into the portal. In simple terms, we are going to facilitate digital trading of agriculture commodities. Digital trading of agriculture commodities. Everybody is able to follow the discussion. So, Electronic National Agriculture Market, Small Farmers Agribusiness Consortium is the nodal authority. It will integrate the APMC mandis on the platform. What kind of crops are covered? This can be a potential question. What kind of crops are covered? You are covering cereals, you are covering oil seeds, you are promoting the trade of fruits, vegetables, spices, etc. So thousands of the APMC mandis have been brought onto the ENAM platform for the promotion of agriculture trade. And the object is very simple. When you are going to promote the trade of the agriculture commodities online, the different buyers now can basically easily participate on the trading. Reason behind this is, until now, when you have APMC law, the buyers, that is the traders, when they participate in different states, they were supposed to have different licenses, multiple licenses. Under the ENAM system, multiple licensing requirement is not there. There is no requirement of multiple licensing. A single unified national license is more than sufficient. Single unified national license. So interstate trade promoted, intrastate trade promoted, ease of participation for the buyers is also promoted. That is the objective of Electronic National Agriculture Market. Okay, final concept in the agriculture sector, food subsidies. Right? Final concept under the agriculture, food subsidies. What is the basic idea for food subsidy? The overall expenditure that the government of India will incur in order to procure and distribute the food grains. The government will procure the food grains and distribute the food grains. But for this, the government of India will incur certain expenditure which it cannot recover. Which it cannot recover. So this kind of an expenditure is nothing but food subsidy. So government will procure the food grain, and please understand, when I say procurement, there are two types of procurement. This can be asked in the preliminary examination, two types of procurement. One is a centralized procurement and the second one is decentralized procurement. Centralized and decentralized. Centralized means the government of India through FCI will procure food grains. The state government will procure, transfer it to FCI. All of the food grains are pooled. This is called as a central pool. From the central pool, now the food grains would be allocated. This is basically centralized procurement. For the states which are procuring and transferring to the FCI, there is commission that is paid by the center. Centralized. In case of decentralized, the food grains are procured by the state government and stored by the state government, distributed by the state government. If the state government will end up procuring more than what it requires, if it procures more than what it requires, the extra is transferred to the Food Corporation of India. And for conducting all of these operations, center will pay commission to the states. This is called as decentralized procurement. Very recently, the state government of Madhya Pradesh has asked the central government to take Madhya Pradesh out of decentralized and put it under centralized procurement. These are the important points. So, food subsidy, center will procure the food grains. Listen to me carefully. Center will procure, FCI will pay MSP, and after paying MSP, there are other additional expenditures. Right? What do you mean by additional expenditures? They will simply use the term procurement incidentals. Please remember this. They will simply use the term procurement incidentals. For example, payment to the, right, let's say mandis. Right? That is some of the charges that they will have to pay to mandis. Payment that they will have to do for purchasing the bags. Payment for labor, etc. So one is the procurement cost, and then there is a procurement incidentals. After this, there is a distribution cost. After this, there is a distribution cost. Right? So all these factors put together, all these expenditures put together, right, the government will incur a subsidy expenditure which is called as a food subsidy. And another very important component before I move on to the next one, whenever the government of India will procure food grains by paying MSP, some of the food grains are procured and stored as buffer stock. Some of the food grains are procured and stored as buffer stock. What is the logic of a buffer stock? Government procures, stores them so that whenever there is a shortage, whenever there is a shortage in the market, they could release these particular buffer stocks in the market. Done? Everybody is okay? Right? Can I move forward now? Do let me know. Can I move forward? Now the last concept within agriculture, right, more of a current affairs concept anyways, Kisan Credit Card Scheme. This was also there in the newspaper. Kisan Credit Card Scheme. The Kisan Credit Card Scheme was launched back in the year 1998. The credit card scheme, that is KCC, will cover owners, right, who are cultivating on their own farms, that is the owner cultivator farmers, tenant farmers, sharecroppers, self-help groups, etc. Right? So different kind of cultivators are covered under the Kisan Credit Card. Now, loans are provided for the, right, let's say the beneficiaries under this for purchasing agriculture inputs, for purchasing certain assets, for maintaining, that is taking care of working capital, even for taking care of household expenses, even for taking care of household expenses. And they can use the loans under this for allied activities as well, that is agriculture and allied activities. Now, apart from this, what is important point in the context of Kisan Credit Card? Very recently, there have been certain changes announced to the Kisan Credit Card. Right? Have a look at this. the loan limit has been raised from 3 lakh rupees to 5 lakh rupees. Please remember, the loan limit has been increased from 3 lakh rupees to 5 lakh rupees, and the loans that you can borrow, right, without any collateral, until recently it was 1.6 lakh. Now without collateral you can borrow up to 2 lakh rupees. And the concept of modified interest subvention scheme, MISS, modified interest subvention scheme. Under this, right, that is under the MISS, you can take a loan of 3 lakh rupees at 7% and you will be given an interest subvention of 3%. Meaning what? The 3% rate of interest burden will be borne by the government. You don't have to bear that particular 3% rate of interest burden. In fact, right, from 7%, after the government pays 3%, it will come down to 4%. In fact, there is one more component, that is prompt repayment incentive. Prompt repayment incentive, wherein if you are repaying the loan on prompt basis, additional 2% interest subvention is also provided. Right? So these are certain important concepts associated with agriculture sector. Now can I move on to the next one? All those who are present, please do let me know. Can I move on to the next one? Peter Parker, my dear, long time no see. Can I move on to the next one? Okay, great. Let's continue. Next important area for prelims examination, exchange rate market. Exchange rates. What is the basic idea for exchange rate? Right? Exchange rates, right? Again, there are different types now. Let me start with the basic idea. Okay, exchange rates are representing how many units of the domestic currency you are supposed to pay. Right? How many units of the domestic currency you are supposed to pay to get 1 unit of a foreign currency. That is called as exchange rate. Now under exchange rate, how many you need to understand? You have one fixed exchange rate, you have the second floating exchange rate, and third you have managed floating exchange rate. It is the third one which is actually implemented in India. What is a fixed exchange rate? The government will announce an exchange rate, and the government through the central bank will keep on intervening in the forex market to keep the exchange rate at the same level. Is it okay? Right, the government will announce an exchange rate. $1 is equal to, let's say, 70 rupees, hypothetically. Right now it looks like a dream, but anyways, $1 is equal to 70 rupees. Now, in order to keep the exchange rate at $1 is equal to 70, the government and RBI will keep on interfering in the market. That is basically the concept of fixed exchange rate. And that is the reason when a country follows a fixed exchange rate, there is also a term called as pegged exchange rate associated with fixed, by the way. So argument is, when the country follows a fixed exchange rate, it needs to have huge amount of forex reserves. It needs to have huge amount of forex reserves, right? Second one is floating exchange rate. Floating means the market price, that is a dollar rupee, the price of that will be determined by supply and demand forces. What is the demand for dollar? What is the supply of dollar? What is the demand for rupee, supply of rupee? These factors will determine what is the exchange rate. This is called as floating exchange rate. Right? And there is a third one, which is basically a mixture of both. Managed floating exchange rate. India uses managed floating. IMF refers to this as a dirty float. What is the basic idea? The basic idea is RBI will allow only the market forces to determine the exchange rate. I repeat, RBI will allow only the market forces to determine the exchange rate. But if there is a lot of volatility, there is a fast appreciation, fast depreciation, etc. In such cases, whenever there is excess volatility, central banker will interfere. Central banker will interfere to stabilize the exchange rate. Remember the term, stabilize the exchange rate. This is basically the concept of managed floating exchange rate, which is implemented in India. How does a central bank interfere? Please remember the term as well. It will basically, right, let's say, go to the spot market and start selling or buying the foreign currencies. One way of interfering is either, right, according to the requirement, by the way, right, it will start selling or buying the foreign currencies. Everybody is able to understand when I say according to the requirement. right? It can do it in the spot market, or it can basically enter into swaps. It can basically enter into swaps with the banking sector. For example, RBI in the recent times has been entering into swaps with multiple banks for a period of 3 years, for a period of, let's say, 4 years, etc. That will ensure there is a stability of exchange rate. Let's say there is too much of a depreciation of rupee. RBI will enter into swap where it will provide dollars today. It will go to, right, let's say spot market and sell dollars today to stabilize. That is a basic idea. But associated with this, please remember one more term, right? Please remember one more term. When RBI will interfere like this, it can also lead to one way reduction in the money supply, and in another way excess supply of rupees in the market. Is it okay? Right? RBI, when it interferes like this, it can lead to either excess supply of rupee or reduced supply of rupee. RBI, in order to negate or reduce the impact of this, will also conduct OMO on the other side. Please remember this as well. RBI will conduct OMO, open market operations, on the other side. And this activity of Reserve Bank of India to, right, basically negate its intervention in the forex market by conducting OMO is called as sterilization. This is called as sterilization. Remember, the term has been used once in the UPSC Prelims. They can ask you again, looking at what is happening in the current affairs right now. Okay, come back to the discussion. Whenever you are talking about fixed exchange rate, you use the term devaluation and revaluation. And when you are using a floating exchange rate, for example, India, we say floating exchange rate. The terms that we use is depreciation and appreciation. Remember, the technical terms can be asked in the prelims, right? Now, on what basis the exchange rates are influenced? What are the factors, right, which will influence exchange rate? For example, monetary policies. That is when the central banks will change interest rates. When interest rates are changed, it will attract foreign investments or it can force outflow of foreign investments. That will influence exchange rate. The trade that we conduct, imports and exports, example, gold imports, example, crude oil imports, that will also have an influence over exchange rates. The deficits, right? For example, if India has very high trade deficit, if India has very high current account deficit, which is a fact right now, right, that will also basically have an influence over the exchange rates. The incomes of the people, with higher incomes, we demand more and more goods and services, right? Let's say there will be import of goods and services. There will be import of raw material. There will be import of luxury products. That will also influence exchange rates. Inflation. Whenever inflation is very high, it will reduce the real earnings. It will reduce the real earnings. And it will also make the imported products much more cheaper compared to, right, the goods which are manufactured in the domestic market. All of these will have an impact on exchange rate. Political stability of the country. Political stability of the country. So when the economy is more stable, right, when there is government, when there is stable government, when it will have effective policy formulation as well as implementation, that can either attract investments or that can basically prohibit a lot of investments. And finally, GDP growth of the country. GDP growth of the country. Any economy that keeps on registering very good growth rate, that will attract a lot of investments. That will have an impact on exchange rate. Right? Let's move on now. Real exchange rate, nominal exchange rate, nominal effective exchange rate, real effective exchange rate. Real exchange rate basically is the nominal exchange rate adjusted with inflation. Right? Real exchange rate is nothing but nominal exchange rate adjusted with inflation. Meaning what? When you say nominal exchange rate, right now we say $1 is equal to 96 rupees. Correct? Those who do not know, right, be aware of this as well. Yesterday, the rupee has fallen to all-time lowest against the dollar. So let's say when you say $1 is equal to 96 rupees in the forex market right now, this is nothing but nominal exchange rate. That is the exchange rate that is currently used in the market for converting one currency into another currency. That is called as nominal exchange rate. But in addition to simply comparing one currency with another currency, what if I bring in the component of inflation? That is the price levels what is the price of the products in two different countries, India as well as USA. If I bring in the element of inflation, that is the price level, this will be called as real exchange rate. Real exchange rate. Right? So inflation adjusted nominal exchange rate is called as real exchange rate. But please understand, there are two more indicators. Right? Most of you will struggle with this. Don't overcomplicate it. Keep it simple. Nominal effective exchange rate, real effective exchange rate, NEER and REER. Point number one, both are indices. Both are indices. And these indices are published by Reserve Bank of India. NEER index and REER index both are published by Reserve Bank of India. And what is the base year for the publication of both REER as well as NEER? The base year for the publication of REER and NEER is 2015 and 2016. This is the base year for the publication of REER index and NEER index. And the index is published using two baskets of currencies. Please remember this. One basket is 6 currencies. Most of the trading that is done in these 6 currencies. And there is one more basket of 40 currencies as well. 6 currencies as well as 40 currencies. But what is this NEER and REER? In NEER, we are simply comparing rupee value on one side with basket of currencies on the other side. Is it okay? Right? Please do let me know. Don't overcomplicate all of this. You are comparing rupee value on one side with the basket of currencies, right, on the other side. So what is the value of rupee? How is the rupee value moving against the basket of currencies? That is actually determined by looking at NEER index. And what is the importance of observing NEER index? If the NEER index falls, and if the NEER index increases, it generally means there is a movement of value of rupee against the basket of currencies. That is basically the idea. Nominal effective exchange rate. Now there is a real effective exchange rate. Real effective exchange rate means rupee on one side, basket of currencies on one side, along with inflation, along with price levels. Don't overcomplicate it. Trust me when I say this. You can study REER and NEER for 2 hours. Even then, without calculation, you will not understand anything. But don't overcomplicate it. NEER, rupee value against a basket of currencies along with the trade weight. REER, again same rupee value along with basket of currencies, but now trade weight plus price levels. Trade weight plus price levels. That is, what is the real movement? Real movement means adjusted with inflation. What is the real movement which has a huge impact on the trade? That is calculated under REER index. And what is basically the movement of rupee value against a basket of currencies? No adjustment with inflation is calculated with NEER index. Right? So NEER index and REER index. Please go through them. Next, right? What has been the evolution of exchange rates in India? What has been the evolution of exchange rates in India? Till 1991, please understand, once we got the independence, we have followed different methodologies. But till 1991, it was basically a fixed exchange rate. Again, under that, we at one point of time, it was pegged to, right, let's say the pound, British pound. And after that, after 1975, we introduced the concept where RBI used to determine the exchange rate, comparing that with the basket of currencies, etc. So before 1991, it was almost a fixed exchange rate. In 1991, because there was a crisis, because there was a BOP crisis, all of you know this? Because there was a BOP crisis, the government of India went for a two-step, right, devaluation. A two-step devaluation was done by Reserve Bank of India. And after this, we introduced a dual exchange rate mechanism, LERMS, Liberalized Exchange Rate Management System. Liberalized Exchange Rate Management System. It was introduced for 92 and 93. What was the basic idea? We wanted to move from a fixed exchange rate to a floating exchange rate. From a fixed to floating. Suddenly you can't do. As a temporary mechanism, we announced a LERMS. That is a dual exchange rate. Under this particular LERMS, 40% of the currencies would be exchanged at government notified exchange rate. and remaining 60% would be converted at market determined exchange rate. And because we used two systems of exchange rate, this was called as a dual exchange rate. It was introduced in 92 and 93, and after that we have shifted to a market determined exchange rate. After India accepted the Article 8, remember this can be asked suddenly in the prelims examination. After India adopted Article 8 of the IMF agreement on articles of agreement. So from 1994, we have introduced the concept of current account convertibility. We have shifted to market determined exchange rate. We have shifted to concept of market determined exchange rate. Okay. Now these are certain important points in the context of exchange rate. One more last concept in the context of exchange rate, purchasing power parity. Important, please remember this. Purchasing power parity. Very often you will come across India's GDP ranking, correct? You will come across India's GDP ranking. First and foremost, please remember, the GDP ranking globally is always published in terms of dollars. We calculate in rupees. Globally, it is published in terms of dollars. Please remember that. Right. So according to the World Bank latest report, India is ranked 6th position, not as government claimed earlier 4th position. This is according to the latest data published by World Bank. But when you talk about rankings of GDP, the ranking of GDP is also done under two methods. One, when you take nominal exchange rate. When you take nominal exchange rate and publish GDP ranking. And the second one is when you take exchange rate at purchasing power parity. When you take the exchange rate at purchasing power parity. Based on that also a GDP ranking is provided. Nominal exchange rate is basically what is the current exchange rate in the forex market. What is the purchasing power parity exchange rate? It is the exchange rate which is calculated by taking a common basket of goods and services. It is the exchange rate that is calculated by taking a common basket of goods and services. That is in India and USA. If you want to purchase the same quantity of the goods and services, similar goods and services, how much money will be paid in India, how much money will be paid in USA. You take those exchange rates and that is called as purchasing power parity. Everybody is okay? That is called as purchasing power parity. So India's ranking in terms of purchasing power parity is always much greater, generally ranked at 3rd. And the GDP also, when you calculate at purchasing power parity, it is much greater, usually 3 times compared to the GDP that is calculated at the nominal exchange rate. Please be very careful. So compare currencies with the basket approach. Whenever the real exchange rate, RER, whenever the real exchange rate is equal to 1, we simply say currencies are at parity. Whenever real exchange rate is equal to 1, we simply say the currencies are at parity. This is basically a statement that is given in the NCERT book as well. Please be very careful. Okay, now these are the things I wanted to discuss from the context of exchange rate. Let's move on to the balance of payments now. Let's move on to the concept of balance of payments. What is a balance of payment? It is a systematic record of all the transactions between India and rest of the world. Is it okay? It is a systematic record of all the transactions between India and rest of the world. RBI prepares the balance of payments. According to IMF, the balance of payments is supposed to have 3 accounts. The current account, capital account, and the third one is financial account. RBI generally produces the balance of payments including 2 accounts. It also publishes with 3 accounts, but historically RBI has been publishing balance of payments having 2 accounts. One is the current account. The current account fundamentally will include or record all the transactions that are connected to incomes, the transfer payments, the payments paid and received for goods and services, balance of trade and visibles. These are the transactions which are recorded in the current account. There is also capital account. In the capital account, you generally list out the transactions which are related to assets. For example, FDI coming in, FPI coming in, borrowings under the external commercial borrowings, etc. All these are recorded under the capital account, and let's say the remittances coming in, remittances going out, income payment, investment, investment income, right? Investment, payment, etc. All these are, right, basically listed under the current account. Okay, 7007 PK is saying it is buffering. Is it the same for everybody? Do let me know. Right? 7007 PK is saying there is a buffering issue. Is it the same for everyone or should I continue? And simply ask 7007 PK to refresh. Okay, please check 7007 PK. Please refresh from your side. Please refresh from your side. Let's continue. So balance of payments, right? So balance of payments is a record of all the transactions prepared by RBI. It will have the transactions which are conducted between India and rest of the world. Okay, right? So one more very important point associated with the BOP before I talk about the deficits is RBI, right, will be responsible for maintaining the BOP. RBI will also have, right, let's say forex reserves. If there is any shortage of the forex reserves, if there is excess of dollars in the market, the balancing act is always done by RBI. RBI has to do the balancing act. Let's say dollars are not available, RBI will supply dollars. If excess dollars are available, RBI will take away the dollars. Okay. So the sale of official reserves is conducted by Reserve Bank of India. Now, right, I said there are types of deficits, different types of deficits within the balance of payments. What are the different types of deficits? Let's start. First one is the trade deficit. The basic idea for trade deficit is the imports value are greater than the export value. This I'm pretty sure all of you know it by now. Right? So India generally has a trade deficit. There is a current account deficit as well. That is the outflow, the payments we are doing under the current account is greater compared to the income that we are earning. India has a current account deficit as well. And please remember a term, the current account deficit as well as the fiscal deficit, both of them put together, these are called as twin deficits. These are referred to as twin deficits. Right? So there is also a BOP deficit. What is a BOP deficit? Overall payments that we are doing under the balance of payment is lesser compared to overall incomes we are receiving. This is called as a BOP deficit. Right? Generally, India has a trade deficit. Generally, India has a current account deficit. Next one, BOP crisis. BOP crisis simply refers to a situation wherein there is a situation that you're exhausting all of your forex reserves to address the deficit in the BOP. In order to reduce the BOP deficit, you're exhausting all of your forex reserves. That is called as a BOP crisis. The last time India faced a BOP crisis was back in the year 1991, not 71, 1991. After that, RBI has steadily increased the amount of forex reserves which are held, and today the forex reserves that are held with RBI has an import cover of more than 11 months. Import cover of more than 11 months. Remember all of this. What is the meaning of import cover? How much forex reserves you have which is sufficient to import for how many months. The forex reserves that you have is sufficient to import for how many months. This is called as import cover. Import cover of Reserve Bank of India is right more than 11 months now. Right? Now, within the BOP, there are two types of transactions, autonomous transactions and accommodating transactions. What is autonomous? These are the kind of transactions which are economic in nature. These are transactions which are done naturally. These are basically the kind of transactions which are driven by profit motive. For example, remittances coming in, remittances going out. Right? The imports coming, imports going. Right? Or for that matter, investments coming into India, investments going out of India, etc. So when you talk about these kind of transactions which are driven by the economy, these are called as autonomous transactions. But please understand, because of these autonomous transactions, there can be a deficit. There can be a deficit. So when there is a deficit, the Reserve Bank of India will try to intervene. The government of India will try to borrow from the IMF so that sufficient dollars are made available in the India's market, etc. So the transactions which are conducted to adjust the imbalance in the BOP, the transactions which are held to address the imbalance in the BOP, these transactions are called as accommodating transactions. Please remember, these are done to address the imbalances in the balance of payments. Done? Right? And the last concept regarding the BOP here, The current account that is under the BOP is fully convertible in India. Fully convertible means there are no restrictions in terms of converting rupee to dollar, dollar to rupee. You're exporting something, you are you are getting, right, you're exporting something, you're getting dollars, you can convert all of those dollars at a price that is determined by the market right now. That is basically the concept of full convertibility. So current account under the BOP is fully convertible. Capital account is partially convertible. Capital account is partially convertible under BOP. Please remember this. There is a committee recommendation. In fact, the committee was set up twice, by the way. SS Tarapore Committee. SS Tarapore Committee. The SS Tarapore Committee has recommended that we must promote capital account convertibility. But in case of India, because the government RBI is worried about capital flight, sudden capital flight which can create instability in India, that is foreign investors simply taking out huge amounts of money because there are no controls whatsoever. So that might create a lot of issues in terms of financial stability. That's the reason we have full current account convertibility, but partial capital account convertibility. Everybody is okay? But does it mean we are not allowing any kind of reforms to move towards full convertibility under the capital account? We are implementing it. It will take time. Satyajit, my dear, did I address your doubt? Do let me know. While explaining, I've addressed your doubt, by the way, just now. Okay, next concept, last concept, in fact, under the international trade is economic integration. Economic integration. What is this idea of an economic integration? Countries coming together to have trade amongst themselves. Countries coming together and provide beneficial or preferential treatment for themselves. Is it okay? Preferential treatment for themselves. Everybody is okay? This is called as economic integration. Right? So economic integration essentially is done at different levels. The lowest level of economic integration is a preferential trade agreement, PTA. Under PTA, very small part of the trade is covered and the member countries in the group will agree to reduce the tariff. It is more focused on the tariffs and very small part of the trade, that is preferential trade agreement. After PTA, a better level of integration or a higher level of integration will be FTA. India generally focuses on FTA, generally, okay. Under FTA, the coverage of the trade is substantial. Most of the trade is covered or all of the trade could be covered. It all depends on the kind of agreement you want to have. Right, so most of the trade is covered under FTA. Right, so in this, there will be reduction in the tariff, elimination of the tariff, etc. But please understand the FTAs which are comprehensive in nature. The FTAs which are comprehensive in the sense, along with the trade, you cover, let's say, services, you cover, right, let's say, investments, you are covering, right, movement of labor, that is migration pacts are there, you are covering intellectual property rights, etc. So when this particular agreement is very comprehensive, not just restricting to trade, but going beyond the trade, these kind of agreements which are FTAs are also referred to as SEPA. Have you come across this? Comprehensive Economic Partnership Agreement. They will also use the term SECA, Comprehensive Economic Cooperation Agreement. Right, so different names are given, but the idea is very simple. The agreement is not just restricted to, right, let's say, the trade. Agreement is going beyond the trade, covering many other areas. That's the reason comprehensive term is used. Then after FTA, there is a customs union. Customs union means what? The countries which are there in the grouping, now these will have common tariffs when these countries will trade with other countries. For example, take the countries in the European Union. You want to trade with these countries. All the countries of European Union will have the common customs, common tariffs when other countries will trade with them. Right? That is basically, right, the customs union. Then there is a common market. What is a common market? It is a type of a customs union where the member countries now will have free movement of labor, will have free movement of capital, etc. Now the countries will basically have free movement of labor amongst themselves. Best example for this is again European Union. European Union is an example for all of them. Right? So in case of customs union, these countries will have same tariff when they trade with other countries, that is out of the, right, let's say grouping. In the common market, there will be movement of labor without restriction, movement of investments without the restriction within the grouping. Then there is the final, the economic union. Highest level within economic integration, the economic union. In the economic union, essentially what you will see is, it's a type of a common market which will have a common, right, let's say policy. It will have a common monetary policy. It will have a common, right, let's say economic policy. It will have a common executive, same currency, etc. So when you have these kind of groupings, right, which will have common monetary policy, common executive, etc. Again, European Union is a prime example. I can give you multiple examples. Rather than remembering multiple ones, try to remember the ones which are there in the current affairs. Simplest one is European Union. So this is called as economic union. Right? This is basically called as economic union. That is, within the European Union, there are more than 20 countries. In fact, 21. Algeria now. 21 countries have the same currency, that is euro. Algeria has joined very recently to the European Currency Union, etc. So these are the different levels of economic integration. The lowest level is PTA. The highest level, again, in economic integration is economic union. I'm emphasizing on this because when you talk about union, can you go beyond economic union? There can be political union as well, but that is more to do with, right, political science. Economic union is, right, basically associated with GS paper 3. Okay, can we go forward now? Do let me know. Can we move forward? Next, can we move on to the next chapter? Again, related to international trade only. Great, let's go forward. I want to discuss important points, right? Let's say cover important points associated with three important global organizations. Three important global organizations. Starting with World Trade Organization, WTO, World Trade Organization. Okay. Now, what are the important points regarding World Trade Organization? Let's start. Initially, we had GATT, General Agreement on Tariffs and Trade. GATT was basically enforced or came into implementation from 1947. India was a party to this, but GATT was limited to goods. GATT was not an organization, it was simply an agreement. So over a period of time, there was negotiations, right? There were 8 rounds of Uruguay rounds of negotiations, etc. So after the negotiations were conducted, we basically established from 1995 World Trade Organization, WTO, World Trade Organization. India is a founding member of GATT also. India is a founding member of, right, World Trade Organization as well. Now, right, the World Trade Organization, the highest decision-making authority. The highest decision-making authority is the Ministerial Conference. All the member countries are party to the Ministerial Conference. It is conventionally, right, that is traditionally, it is conducted once every 2 years. Right? Very recently also it was conducted. So once every 2 years, the Ministerial Conference is held. Now, what are the other important points? Right? The Ministerial Council will meet once every 2 years, and this is the highest decision-making body. But to take care of the day-to-day operations, just to take care of the day-to-day operations, there is one more, right, part of the WTO, General Council. General Council. So General Council, right, will take care of the day-to-day activities or day-to-day decision-making of World Trade Organization. It is the General Council which will act as a trade policy review body, which will review the policies of the member countries. It will also act as a dispute settlement body. Remember this. The General Council will act as a DSB as well as TPRB. Right? The functions are conducted by both by the same authority. Now, the headquarters of WTO is located in Switzerland. The origin of WTO can be traced back to Bretton Woods Conference, which happened back in 1944. The idea was to create a body to regulate global trade. It was not set up. That's the reason we entered into GATT. right? There was also objective to set up, right, a body to promote redevelopment, that is loans should be given to the countries, etc. World Bank was set up. There was also need to set up a body to regulate exchange rates, which is followed by many countries or member countries, etc. That's the reason we set up IMF, outcome of Bretton Woods, right? The World Bank is the outcome of a Bretton Woods. That's the reason both of them put together are also referred to as Bretton Woods twins. But the idea of WTO, initially we wanted to set up ITO, International Trade Organization. Not possible, no consensus. We settled for GATT, and then we had 8 rounds of Uruguay negotiations culminating into 1995, we establishing or starting WTO. Done? Okay, what are the important principles of WTO? Most favored nation. That is, there can be no, right? Listen to this carefully. There can be no discrimination followed by one country with its trading partners. Non-discrimination, that is most favored nation. Then there is a national treatment. Once this has come into your country, it could be investment, it could be a good, it could be a service, whatever it is. Once it has entered into your country, you cannot discriminate between imported as well as domestically produced. That is national treatment. No discrimination. Then there is a promotion of free trade by eliminating, reducing the trade barriers and trying to reduce the non-tariff barriers. Right? So reduce non-tariff barriers, try to reduce and eliminate tariff barriers. So these are certain important points associated with World Trade Organization. Now, what are the important agreements that you are supposed to go through? Important agreements. First one is Agreement on Agriculture, AOA. Agreement on Agriculture, right? It's basically going to regulate the amount of the aggregate measure of support. That is the support that is provided by the government to agriculture sector. There are 3 important pillars under this. Please remember, one is domestic support, second one is the market access, third one is the export subsidies. The most important one is the domestic support. The member countries are divided into developed and developing. And please understand, developed and developing under WTO is based on self-declaration. So if you are a developing country, then the aggregate measure of support that you are providing, that is a trade distorting subsidies that you are providing, should not be more than 10% of value of your production. And if you're a developed country, then the aggregate measure of support should not be more than 5% of the value of production. This is determined under the concept of de minimis principle or de minimis level. And there is also one very important clause associated with this, that is a peace clause. It is an outcome of 2013 Bali Conference, 9th Ministerial Conference, 2013 9th Ministerial Conference of WTO, which was held in Bali. That is, right, because India with many other countries stated that they would not give a consensus for the implementation of the agreement. There was an agreement called as a Trade Facilitation Agreement. So the member countries provided a peace clause, which was basically driven or led by USA. Right? So they introduced the peace clause. Peace clause simply means if a developing country, when it wants to provide food security, is violating the de minimis level. I'll repeat the statement. Member country, a developing country, which is right providing food security and in the process of that violates the 10% limit. In such cases, other countries cannot file a complaint against this member country. That is, in a nutshell, a peace clause. But there are conditions to that. A lot of conditions are attached to peace clause. Done? Everybody is okay? Now, the subsidies provided to agriculture under this are divided into 3 types, classified into 3. Amber box subsidies. These are purely trade distorting subsidies, hence should be limited, should be controlled. Green box subsidies. These do not create a distortion or create a negligible distortion, so no limit. Blue box subsidies. These are trade distorting but will be used for limiting the production. I'll repeat it. The blue box subsidies are trade distorting but will be used for limiting the production. That's the reason no imposition or restriction on the blue box subsidies as well. Okay, so these are the important points regarding agreement on agriculture. Let's move on. Another agreement, GATS, General Agreement on Trade in Services. Under GATS, the international trade in services is classified into 4 categories. Or they will simply say 4 modes. right? You have cross-border supply, right? Presence of natural persons, commercial presence, etc. So there are four classification of trading of international services. Now these particular international trade in services will come under the regulation under the promotion of General Agreement on Trade in Services. For example, MFN treatment, national treatment, etc. All these principles by default are covered under the GATT's agreement. Next one, TRIPS agreement. TRIPS stands for Trade Related Aspects of Intellectual Property Rights. Under the TRIPS agreement, it basically says that the member countries individually will have to have laws, rules, etc. in order to provide protection to the intellectual property rights. Intellectual property rights such as patents, copyrights, right? Or for that matter, let's say the designs, right? Etc. So these kind of intellectual property rights should be given the protection by the member countries by having individually the laws. This is basically provided under the TRIPS agreement. Then there is a TRIMS agreement as well. Trade related investment measures. This applies to again the member countries where the member countries are to have laws in order to facilitate, in order to promote investments in goods. That is the investments which will help in the production and export of goods. The member countries should not formulate a law prohibiting the investments. They should have a law to facilitate more and more investments. That is provided under the TRIMS. And finally, Agreement on Subsidies and Countervailing Measures, SCM. This particular agreement essentially ensures that the member countries which are exporting, which have achieved to certain extent, let's say competitiveness in the international market, they will not continue to provide export subsidies. For example, under the SCM, it says that if a particular country has achieved a per capita national income of more than $1,000 for 3 consecutive years, more than $1,000 for 3 consecutive years, then such a country cannot continue to provide export linked subsidies. Right? And there is also one more condition. If a particular country has a sector which is exporting sector and this particular sector accounts for more than 3.25% of the total global exports, then this country cannot continue to provide export linked subsidy. This country cannot continue to provide export linked subsidies. Everybody is able to understand? Right? So these are certain important points in the context of WTO. Now final, that is dispute settlement body. How the WTO's dispute settlement body works. Right? You have a dispute settlement body. A member country will file a complaint or take a complaint against another country. Now, the dispute settlement body initially will ask the member countries in a complaint to resolve the dispute amongst themselves. They will simply say, can you have mediation and resolve? Can you negotiate and resolve, etc. If the member countries are not able to resolve the complaint now, right, there will be a panel, set up. Now, the panel will be appointed. This particular panel will conduct investigations, submit the report. The member country is allowed to go to appellate body and file, and review. Appellate body is supposed to have 7 members. Right now, there are absolutely no members in the appellate body. Please remember that as well. So 3 members will sit, hear the appeals, and then the appellate body can reverse the order, can modify the order or modify the report, or can altogether, basically accept the report. So appellate body, and after appellate body, you go to dispute settlement body where voting will happen and the report will be either upheld or rejected. This is basically the concept of dispute settlement whenever there are trade disputes. Please be very careful. Trade dispute. Right? Whenever there are trade disputes, this is how the dispute resolution is done under WTO. Done, everybody is okay? Can I move on to the next important authority? We have covered WTO. And by the way, those who are asking PDF, my dear, I'll give you PDF later. Have patience. Please listen to the discussion first. Okay. Next, International Monetary Fund. IMF, International Monetary Fund. IMF was set up back in the year 1944. How many member countries are there in the IMF? Latest data, 191. Under WTO, the latest data says 166 members. Please be very careful. WTO 166, IMF 191 countries. IMF is one of the Bretton Woods, right, twins. IMF and World Bank, Bretton Woods twins. Now, headquarters of IMF is located in Washington. The most important authority, highest decision making authority under IMF is the Board of Governors. In the Board of Governors, there are two positions, the governor, alternate governor. Every member country will appoint governor and alternate governor. Okay. For example, India, the IMF governor, right, from India, IMF governor will be finance minister. RBI governor will basically be the alternate governor. Okay. So it is the highest decision making body of IMF. It will decide regarding which should be allowed to enter into IMF country, which country should be removed from IMF, what should be the SDR, that is a special drawing right given to the member countries, right, etc., etc. All of these important decisions are done by Board of Governors. But Board of Governors cannot work on day-to-day basis. There is one more important authority, please remember this. It is the Executive Board. Executive Board will take care of the day-to-day operations of IMF. The Executive Board will have a composition of 25. 24, right, that will be directors and one will be executive director. These 24 plus 1 essentially are representing different group of countries. That is, these 190 countries are divided into different groups. Each of the group will have one representation. Some of the countries will have individual representation, for example, USA. But other countries such as India, we will be clubbed into different groups and we will have one representation. So 24-1, right, that is basically the Executive Board. So day-to-day operations, decision making, etc. of IMF is conducted by the Executive Board. Now, in addition to this, the advice to the Board of Governors. There is advice. There are two important committees which will keep on giving advice to the Board of Governors. Please remember, one is the IMFC, International Monetary and Financial Committee, and the second one is the Development Committee. These are the two different committees which will keep on giving advice or the inputs to the Board of Governors for day-to-day policy, for the important policy making decisions. Now, what are the important points in the context of IMF? Let me start with the first one, quota. Important quota. What is the basic idea for quota? IMF website says quota is the building block of IMF. Quota is the building block of IMF. But what is the meaning of quota? Quota is basically a number that is given to a country based on a formula. Quota simply refers to a, right, let's say a representation of a country in the form of a number. How do I find out the number? There is a formula. There are 4 parameters which are used to calculate quota of every member country. These 4 parameters are 1. GDP, gross domestic product. Second one is openness. Third one is economic variability. And the fourth one is forex reserves. And all these 4 are given weightages. And the way I've written is basically in decreasing order of weightage. Decreasing order of weightage, please remember that as well. Right? GDP is given the weightage of 0.5. Right? Openness is given a weightage of 0.3. The economic variability is given a weightage of 0.15. And the reserves are given a weightage of 0.05. So I've already arranged them in a decreasing order. Please memorize this. So this formula is used to identify what is a quota of every member country. And once a quota is determined, the country will be having to represent, the country will have to donate. Donate means contribute a certain amount of money to IMF. That is on quota basis only. How much loans you're allowed to take from IMF? That is determined by quota. What is the SDR, special drawing rights, which will be given to you? That is determined by quota. Right? And please understand, quota will also determine, or using quota, the IMF will also determine what is the voting right of the member countries under IMF. So all these are the important, right, let's say outcomes of calculating quota. Now IMF, there are multiple objectives or multiple functions. The most important function of IMF is lending activity. IMF is involved in the lending activity. Now, when IMF is involved in the lending activity, IMF first and foremost has to collect resources. Very simple. It has to collect resources. So what are the different ways through which IMF will collect the resources? The source of funds, there are three important source of funds. One is quota. This is called as the first line of defense. Then we have new arrangements to borrow, NAB, second line of defense. And then there is a third line of defense, which is called as a bilateral arrangement. Quota is always there with the IMF. If IMF requires more than what is there under quota, it will activate NAB. And after activation of NAB, even then if it requires money, it will activate bilateral borrowing agreements. Right? So this is generally how the activation or the access to the resources are done by IMF. Now once IMF has access to funds, it will lend. It will provide loans. Now these particular loans essentially are two types. IMF loans can be classified into two. Right? There are too many, but for UPSC, I'm just differentiating two types. One is a concessional lending and the second one is non-concessional lending. What is the fundamental difference? If you are, right, let's say a very poor country, if you are, right, underdeveloped country, low income country, then the IMF will allow you to take loans up to certain limit without, right, let's say interest, with very relaxed conditions. These are called as concessional loans. These are given to low income countries. These are given to low income countries. What are the names? Please memorize the names. Extended credit facility, standby credit facility, and rapid credit facility. These are, right, only given to low income countries, but up to certain limit. And who will decide what is the limit under this particular, right, let's say tool? Quota, right? How much is your quota? That will determine how much loan you're allowed to take under each one of them. Now there is a non-concessional lending as well. Under non-concessional, this is available to all the member countries, right? Under this, there are different types of, right, let's say lending that is done by IMF, but here interest rate is charged. Conditions are much more strong or strict compared to non-concessional. We have standby arrangement, extended fund facility, flexible credit line, short-term liquidity line. And those who are wondering, sir, why different names? Why can't we simply provide one loan under the, right, let's say concessional as well as non-concessional? The argument behind this is it all depends on what situation the country is facing. Is it, let's say, a situation wherein structural problems are causing BOP crisis? Is it a short-term problem leading to BOP problem? Is it a medium-term problem, etc.? So based on the intensity, based on the situation which is causing the crisis in the BOP, different types of loan facilities are provided. But in addition to this, not alone, in addition to this, there is one more facility that is available to all the member countries of IMF. All the countries of IMF. That is called as a gold tranche or reserve tranche. It is basically under this facility that the member countries which have deposited quota money, they have deposited quota money with the IMF up to 25%. Up to 25% of the quota contributions can be, right, taken back. The member countries can take up to 25% of their quota that they have given to IMF. Not alone, they can simply take. That's the reason under gold tranche, when you take the money, you don't have to come under any kind of conditions. You don't have to pay any charges, etc. This is a gold tranche or reserve tranche. Now, final concept under IMF, special drawing rights. Final concept under IMF, special drawing rights, SDRs, special drawing rights. What is a special drawing right? It is a notional, I repeat, it is a notional or a reserve asset that has been issued by IMF. It's a notional currency. What is the meaning of it? The STR is basically a currency that has been issued by IMF to all the member countries. And using the STR, the member countries will be trading in the sense borrowing, repaying, etc. with the IMF. So please remember, it is a reserve asset which was created by IMF back in the year 1969. And every country, for example, India has a huge amount of reserves right? And under the reserve, SDR is one of the components. And this SDR is not an obligation of IMF. Like rupee which is issued by RBI, SDR is not an obligation of IMF. It is simply a reserve asset. And another advantage of SDR is the value of SDR is determined by IMF by using a basket of currencies. Right? The basket of currency has 5 important currencies. Memorize this. And all these 5 are freely convertible currencies. All these 5 are freely convertible currencies. These 5 are dollar, right? Yen, yuan, euro, and pound. Right? US dollar, euro, and pound. The yuan, that is a Chinese renminbi. The latest currency which has been introduced in the basket, it is the yuan. Latest one, this has been the introduction. Done? Can we go forward now? So we are done with IMF, World Bank, done. IMF, done. Right? Everybody is okay. Lunch is over. You're listening and having lunch as well. But please be focused on listening. Please be focused on listening. Okay. Next, World Bank. Let me cover World Bank. Right? Important area, World Bank. Now, World Bank, essentially, please understand, there are different institutions under World Bank. Generally, in the newspaper, when you come across World Bank, they would be referring to 2 institutions. That is International Development Association as well as, right, let's say the IBRD. But when they use the term World Bank Group, the World Bank Group will involve 5 important institutions. IBRD, IDA, IFC, MIGA and ICSID. I'll discuss each one individually, by the way. Important points only. Right? So when they say World Bank Group, IBRD, IDA, IFC, MIGA and ICSID. All the 5 institutes. Right? Let's start now. First one, IBRD. What are the important points regarding IBRD? It stands for International Bank for Reconstruction and Development. Right? International Bank for Reconstruction and Development, IBRD. It was set up back in the 1944, right? In fact, it was earlier considered as World Bank, 1944. Right now, it has 189 members. The highest decision-making authority under IBRD is the Board of Governors, and day-to-day decision-making, right? Same like IMF, we have executive directors under IBRD, okay? So, what is the important role of IBRD? It will provide loans. It will provide guarantees for different loans taken by the member countries, etc., etc. This is IBRD. Next, we have International Development Association. It is similar to IBRD, but the focus of IDA is on low-income countries. It is similar to IBRD only, but the focus of IDA is on low-income countries. Right, so IDA was set up, International Development Association was set up in 1960. It will basically complement the functions. Complement in the sense IBRD is working in other area and IDA is focused more on low income areas or low income countries. So same function like IBRD but in low income countries. It has 175 members. This is IDA. Then there is International Finance Corporation, IFC. This was there once in the UPSC Prelims examination. Asked once in the Prelims examination. Anyways, set up in 1956, has 184 members. It is focused on providing loans, getting access to loans for the private sector companies, especially in developing countries. And the reason I cited this or I quoted the fact that it was asked once in Prelims was the IFC had issued masala bonds. The IFC had issued masala bonds, and these particular masala bonds were used to provide loans for private sector or invest in the projects of private sector companies in India. So that was the connection that was asked or questioned in the preliminary examination. Then there is MIGA, Multilateral Investment Guarantee Agency. This has been set up in 1988. It is focused on multiple objectives such as reduce poverty. It is promoting investments across the borders, that is the cross-border investments, right? Especially the focus of the MIGA is on the developing countries. It will provide insurance guarantees, etc. Done? So this is MIGA. And finally, the ICSID. Important, please note this. Reason being, when you talk about trade disputes, when you're talking about the trade disputes, the focus is on, right, let's say the World Trade Organization. We have a dispute settlement body there. But what if there is a dispute between, let's say, a country and a private sector company? What if there is a dispute, right, between, let's say, countries, etc.? That is investment disputes. So, whenever there are questions over the investment disputes, who should be resolving this, etc., etc., these disputes are usually resolved by the arm of the World Bank, that is International Center for Settlement of Investment Disputes. That's the reason I said please make a note of it. It was set up in 1966, right? There are around 165 members of it. The focus of this is to settle the disputes. Done. And there is a convention associated with this, the same name, that is ICSID convention. It has been set up under the ICSID convention. Done. So these are the important points regarding the World Bank, and please understand, we can keep on discussing different aspects of the World Bank, etc., etc., right? But what is important for UPSC, let's focus on that only. Done. Can we go forward now? Okay, next chapter I want to cover is the investment models. Different types of investment models. Okay, let's continue. First one, FDI, foreign direct investment. And by the way, before I go forward, everybody is okay? Please do let me know. Can we continue the discussion? Let's see. Can we continue the discussion? This is a challenge for you, right? Let me know. If you say, no, sir, it's not possible, right? I'll break my laptop now. I'll throw away the laptop now or mobile from the window, etc. Do let me know. It's okay, right? Let's continue. Let's continue. Let's finish it in, right, let's say one shot. Let's make it truly one shot today, right? Okay, let's start. So FDI, foreign direct investment. What is a foreign direct investment? Whenever the foreign companies will bring in money and invest in physical assets, that is foreign direct investment. Physical assets such as investing in a manufacturing facility, investing in a, right, civil aviation company, investing, let's say, right, in a service sector company, invest in R&D, etc. So argument is simple. FDI investments are in physical assets. Now the committee based on which the government of India uses to define FDI is Arvind Mayram Committee. The Arvind Mayram Committee has recommended that whenever foreign investments are up to 10% in a listed company, then it will be classified as FPI. And again, when I say in equity, please remember in equity. Okay, so when foreign companies invest in equity and it is up to 10%, it is FPI. But please understand there is a exception as well. That is, you invest up to 9% today. You purchase 9% equity, but you promise that in the next 12 months, you will bring it to 10 or more than 10. You have purchased 9%, but your promise is in the next 1 year, it will be at least 10 or more than 10. In such cases, today itself, you are classified as FDI. Please remember that. Right? So, 10% or more than 10%, FDI. If it is less than 10% in the equity, it will be FPI. Right? This is based on the recommendation of Arvind Mayram Committee. Okay. Next, what are the different routes through which you can bring in FDI? What are the routes through which you can bring in FDI? The routes are, one, the automatic route or the direct route, and the second one is the approval route or the government route. Right? The automatic or the direct route. What is the meaning of it? You can simply bring in the money, invest in this particular sector. You want to set up a company? Start. You don't have to take any permission of Government of India. But the condition is very simple. In the next 30 days, you will have to inform Reserve Bank of India. You will have to inform the Reserve Bank of India. That is basically the automatic or the direct route. What about the approval route? Under the approval route, first you need to take the permission of the government. Only then you can bring in money in India for investment. First take the approval. For example, the government of India, right, very famous now, Press Note 3. Press Note 3 basically says if there are any investments that are coming into India, from the neighboring countries, that is a land bordering countries, they will have to compulsorily take approval. This is there in the newspaper, by the way. Anyways, so one is automatic route and the second one is approval. Under approval, again there are two types. What if you want to bring in up to 5,000 crore rupees? Then you need to take the approval by filing this, by applying for this in a portal that is called as the Foreign Investment Facilitation Portal, FIFP, Foreign Investment Facilitation Portal. If it is more than 5,000 crore rupees, then you will have to take the approval from Cabinet Committee on Economic Affairs. These are the two different routes. Everybody is okay? Now, right, so what are the other important points regarding the FDI? Generally, please understand, the country from where we receive lot of FDI, highest amount of FDI, generally these are Singapore, right, Mauritius as well as USA. And second, in the global ranking, right, in the global ranking, that is in the top 10 countries, India is generally ranked in the top 10 in terms of receiving FDI. And very recently, there is a term also which is there in the newspaper, net FDI. Please remember that also. I'm worried because, right, a lot of you will miss a lot of these current affairs concepts. There's a term called as net FDI. What is the basic idea for net FDI? FDI which is flowing into India and FDI which is flowing out of India. What do you mean by flowing out of India? There will be repatriations. Everybody is okay with the term repatriation? There will be repatriation. There will be outflow, which is basically the investment that is done by Indian companies in a foreign market, etc. What do you mean by repatriation here? Let me give you one example. Imagine you're a foreign investor, you own a foreign company, you have brought in this particular foreign company, right? You have brought in a foreign company and you have set up the foreign company in India. Now you have conducted an IPO, right? You have conducted an IPO, which means you are the owner, you have got the money. You will take the money out of India, or you will sell the ownership to the, right, let's say the entity which is there in India. You will sell it to, right, your joint venture partner, etc., etc. So in such cases, there will be outflow of FDI. So for last couple of months, very recently it has become positive, by the way. For the last couple of months, the net FDI, that was the difference between inflow and the outflow, this was negative. Remember this, right? The inflow as well as the outflow was a negative for last couple of months. Now, other important concepts associated with the FDI is the concept of depository receipts. The Reserve Bank of India has classified the ADR and the GDR as a type of FDI. RBI has classified ADR and GDR as a type of FDI. So what is this? Right? Depository receipts. Depository receipts are basically instruments that are issued by the banks in a foreign market representing shares of another company. And this company is from another country. Is everybody able to understand? I'll repeat it again. Depository receipts are issued by a bank. Issued by the bank means what? Bank is the party, right, which will go to the foreign market and issue them. Okay. So these are the instruments which are issued by a bank, which represent ownership, that is the shares of a company. These are called as depository receipt. For example, Indian company is there. The shares of Indian company, correct? There are shares of Indian company. Now, if there are depository receipts which are issued in America, these are the depository receipts which are issued in America, but these depository receipts represent shares of an Indian company. Because these are issued in America, these are called as American depository receipts. These are called as American depository receipts. Everybody is okay? Focus on the market where it is issued. Focus on the market where it is issued. So if it is issued in America, American depository receipt. If it is issued in the European market, global depository receipts. Right? America, American depository receipt. Europe, global depository receipt. And if these are issued in the Indian market, Indian depository receipts. ADR, GDR and IDR. Okay. right? So these are important points associated with the concept of FDI. Let's move on to the next one. FPI, foreign portfolio investments. FPI simply represent investment by a foreign institution in India. Investment, that is investments which are done by non-resident investments in India in financial assets. In financial assets, that is called as a foreign portfolio investment. Now, a lot of you will simply start typing, is there any difference between FPI, FI, etc.? Let me give you that idea as well. FII earlier was used. Now, SEBI has classified FPI into two categories, Category 1 and Category 2. The FII, which talks about foreign institutional investment, is basically the concept covered under Category 1 itself. That is, we have, let's say the sovereign wealth funds. SWF is sovereign wealth fund. For example, all of you heard of Abu Dhabi Investment Authority, right? Canada Pension, etc. All these are sovereign wealth funds. So sovereign wealth funds, central banks, other financial institutions, etc. When they invest, right, basically these are classified as Category 1. And we have Category 2 where individual foreign investors will invest, family offices will invest, etc. So FPI, according to the SEBI guidelines, are categorized into these two. Please remember, right, into these two. Now, in what way FPI will flow into India? In what way FPI will come into India? There are different ways. One is basically the general route. General route means the Reserve Bank of India, which oversees all of this because dollars are coming in. The Reserve Bank of India is generally worried if there are no restrictions in the sense, if the government is issuing a bond, how much percentage of the bonds can be purchased by foreign investors? If company is issuing a bond, how much percentage of the bonds can be purchased by foreign investors? These are basically the concerns, that is restrictions which are imposed by RBI. Why does RBI impose a restriction? Simple. If no restrictions are there, it is equivalent to full capital account convertibility. The problem here is, today they will come to India. Tomorrow, if there is any uncertainty, they will simply take the money and start moving out of India. I'm pretty sure all of you are able to read the same thing in the newspaper. This is in fact contributing to rupee depreciation. Now imagine when there are restrictions, that is there under the general route. RBI has imposed restrictions under the general route. When there are restrictions, there is so much of pressure on Indian rupee. If there is no restriction, imagine there is no restriction, foreign investors can simply come into India, invest how much ever they want to in government bonds, right, the private sector bonds, etc., etc. That can create much more higher capital flight and create much more, right, financial instability. That's the reason the foreign investors are allowed to invest under the general route but with restrictions. Then there is voluntary retention route, VRR, voluntary retention route. Under voluntary retention route, the foreign investors will be given relaxation. The Reserve Bank of India will provide relaxation. Relaxation in terms of what? The restrictions are relaxed, but these foreign investors will have to invest, right, let's say for certain time period in India. They will have to invest and keep certain amount of money within India. For example, three-fourth of the total investment they are allowed under the VRR, they will have to keep it in India for at least 3 years like this. So this kind of a route has been facilitated by RBI to attract more and more, right, investments. Then there is a fully accessible route, FAR, fully accessible route. Under fully accessible route, FAR, what is generally done? Certain government bonds are identified by RBI. Certain government bonds are identified by RBI. Now, in these government bonds, absolutely no restriction for you to invest. You're a foreign investor. You can invest without any restriction in these government bonds. For example, 5-year government bonds, 10-year government bonds, right? 15-year government bonds, 30-year government bonds. Initially, RBI had covered 5, 10, 15 and 30. But now RBI has realized the interest is not there in the 30-year bonds. Interest is not there in 15-year bonds. Focus is on 5-year government bonds and 10-year government bonds. Done, everybody is okay? This is fully accessible route. Can I move on to the next one now? Do let me know. Can I move on to the next one? Now there is a concept of infrastructure investment trust. Infrastructure investment trust. Now what is this infrastructure investment trust? There are two types of new models of investment. One is InvIT. One is InvIT, Infrastructure Investment Trust, and the second one is REIT, Real Estate Investment Trust. InvIT and REIT. What is the basic idea between InvIT as well as the REIT? Listen to me very carefully. You can invest in the mutual funds. Mutual funds will collect your money, pool your money, invest in stock market, invest in bond market, etc. In the same way, what if you want to invest in infrastructure projects? Is there a pooling facility? Pooling means collecting money from different investors. This is the basic idea of infrastructure investment trust. It's the same model. That is, investors' money will be collected and this money will be invested in different infrastructure projects. This model is called as InvIT. Everybody is okay? So both InvIT and the REIT are regulated by SEBI. Both InvIT and REIT are regulated by SEBI, by the way. Okay. Now, under InvIT, the money is collected and the money is invested in infrastructure projects. For example, roads. For example, ports, airports, etc. So that model is called as InvIT. Whereas in case of REIT, I repeat, in case of REIT, Real Estate Investment Trust, in case of REIT, the investment that has to be done only in real estate projects. Real estate projects. Everybody is able to understand the difference. So all the other infrastructure projects, InvIT, only real estate projects, REIT. But in addition to this, SEBI also imposes certain conditions. Conditions such as whatever money is collected, that is, the projects are invested, projects are generating money now. 90% of the money now has to be distributed to the investors. 90% of the money has to be distributed to the investors. That is one. Second, SEBI also has one more condition. SEBI simply says, the money that you have collected, you want to invest, then at least 80% of the investment has to be done in the completed projects. Right? Maximum 20% you can invest in incomplete, that is ongoing projects. Right? So these are certain important points in the context of both REIT as well as InvIT. Please be very careful. And SEBI also mandates listing of these instruments. SEBI also mandates listing of these particular instruments in the market. Right? So these are the two types of investment models. Please be very careful. If you're worried about taxation, no tax benefits are generally provided by the government regarding all of these investments. Okay. Now, there are two concepts regarding the foreign investments in India: round tripping and treaty shopping. Round tripping and treaty shopping. What is the basic idea of a round tripping and treaty shopping? Okay, somebody is saying, sir, minimum sponsor, etc. My dear, minimum 15% of the units have to be held by the sponsors. Minimum 15% of the instruments, that is the units, they will use the term units. Minimum 15% have to be held by the sponsors. And there is also lock-in period. Lock-in period, that is for certain number of years, they have to hold all of this. Anyways, let's move on now. Round tripping and treaty shopping. What is the basic idea? Round tripping means the money will start from India and again come back to India. Is it okay? The money will start from India and finally come back to India. This is called as round tripping. Everybody is okay? And what is the use of round tripping? Round tripping basically is done in order to disguise. Disguise in the sense, it is done in order to hide the source of money. So round tripping is starting from India and again coming to India. Right? This is the concept of round tripping. Second one is a treaty shopping. In case of treaty shopping, what generally happens is the investors will basically use different countries, that is not just two countries, they will use different countries to channel their money. That is, they will move the funds from country A to country B, from country B to country C, from country C to country D. This is basically called as layering process. And finally, bring all of this money back to India, right? So this is also, right, basically done. Again, objective is simple: to hide the source of money, to basically mask this as, right, let's say funding, investment, etc., to get the benefit of taxation. Right, so these are some of the things, but please understand the difference. Round tripping, you start from India and you bring the money to India. Treaty shopping means you basically, right, are moving from country A to country B, B to C, C to D, D to E, and basically after that, let's say, right, sixth country you will invest, right, in India. That is called as treaty shopping. Why? Again, argument is we want to mask the investment. We do not want to reveal the source of the investment. We want to, right, abuse the taxation structure, etc. So treaty shopping and round tripping. Okay, next, one more important concepts, two more things, then we are done with the investment models. Social stock exchange. Social stock exchange. Yes, yes, is. Social stock exchanges are nothing but separate segments under stock markets. Right, in the stock market, a separate segment has been provided, approved by SEBI, of course. This particular platform or separate segment will be used by the organizations which are dependent on donations. That is the non-profitable organizations. So the non-profitable organizations will be using this particular platform to basically issue certain instruments in the market. And these instruments, right, example of this, zero coupon, zero principal bonds. Zero coupon, zero principal bonds. These instruments are issued in the market. And please understand, these kind of instruments, right, they will not offer any kind of interest in return. They will not offer any kind of a, right, let's say, principal amount also back in return. No principal is given back, no interest is returned to the investor. It is essentially to raise funds in the market, which are nothing but donations. You can simply purchase them. You will not be imposed with taxes, by the way. For example, what do you mean by taxes? These are not tradable in nature. These are not tradable. You can't simply sell, right, zero coupon, zero principal to another investor in the market. So no concept of capital gains, no concept of, right, let's say security transaction tax, etc., etc. But the benefit is simple. The non-profitable organizations, charitable organizations, etc., now will have a platform where they can list their instruments and basically raise the donations. Very recently, this was there in the newspaper as well. That is SEBI now has made one, right, let's say change. What is the change? Until now, if you are registered on the social stock exchange, that is NSE and BSE, if you are registered within 2 years, right, you were supposed to raise money. Within 2 years, you were supposed to raise the money. But now this has been extended from 2 years to 3 years. Remember this. From 2 years, this has been now extended to 3 years. But of course, up to 2 years, normally. But after 2 years also, if you're not able to raise the funds, now you'll have to get the approval for the next 1 year. This is the basic idea. Next, alternate investment funds. I think we have covered alternate investment funds earlier. I think I've covered alternate investment funds earlier, so no point in covering this particular investment model again. Right, let's go forward. Everybody is okay? Can I move on to the next chapter now? Can I move on to the next chapter? Right, the most important chapters are almost done, in the sense, importance in terms of number of questions asked by UPSC. Banking, 3 to 4 questions. Financial market, 1 to 2 questions. Investment model, 1 to 2 questions. Agriculture, 1 to 2 questions. Now we are entering into the smaller chapters where generally one question is asked by UPSC. Let me start the taxation, right? Let me start with taxation now. Now, what are the different types of taxation system? Be very careful, right? A factual question can be asked. You have direct and indirect taxes. Direct taxes, where the tax burden cannot be shifted. Indirect taxes, right? Indirect taxes, where the tax burden can be shifted. Okay, indirect taxes where the tax burden can be shifted. Progressive and regressive. In case of progressive, with the change in the income, with the rise in the income, right, the tax rate imposed and collected will also increase, right? And in case of regressive, with change in the income, right, that is, let's say the income increases, but smaller percentage of the income, I repeat, a smaller percentage of the income will be paid to the government, right? That is progressive and regressive. And in case of the direct as well as indirect, if you want to remember these particular terms, that is incidence and impact. Incidence and impact, if it is on the same person, it's a direct tax. Incidence and impact is on two different taxpayers, that is indirect taxes. Okay, next one is proportional tax. Whatever is your income, same percentage of the income you will pay to the government in the form of tax. That is called as proportional. Same percentage of income you will pay it in the form of a tax, that is called as proportional. Done. Next one is countervailing, anti-dumping and safeguarding duties. Countervailing, CVD, anti-dumping and safeguarding. Right? Listen to me carefully. All the three essentially are connected to international trade. Meaning, if a particular country is exporting a good and is reducing the prices purposely, in that case it is called as a dumping activity. The government of India will impose anti-dumping duty. Simple. They are dumping the goods, you want to offset, negate the impact. Second one is countervailing duty. The exporter is receiving a subsidy from the government. And because they are receiving a subsidy, the price of the product is lower. And that will be exported more to India. Now, to negate the benefit of the subsidy received by the exporter, Government of India will impose a duty, that is countervailing duty, that is anti-subsidy duty. Then there is third one, right, that is safeguard duty. Sudden rise in the imports will start hurting the domestic manufacturers, domestic companies. In order to provide protection to the domestic companies, the government will impose, right, a duty on the imports, that is called as a safeguard duty. Everybody is okay? Everybody is okay with this? Right? So countervailing, anti-dumping and a safeguard duty. In cases of all the three, the investigation is conducted by Directorate General for Trade Remedies under the Ministry of Commerce. The report is submitted to the Ministry of Finance. Notification regarding this is announced by Ministry of Finance and the implementation is done. Done? Okay. Next is ad valorem, the tax when imposed on the value of the product. That is, let's say value of the product is 100, tax is imposed on that, ad valorem. Specific duties, these are imposed on physical attributes of the product. For example, length of the product, right, volume of the product, etc. These are also, that's a reason called as per unit taxes. For example, all of you heard of the central government taxes on fuels. Central government imposes the taxes, a fixed amount, 10 rupees per liter, 20 rupees per liter. Everybody is able to understand? Suddenly UPSC can connect all this concept to this and ask you a question in the prelims. Please be very careful. Listen to me carefully. The central government imposes a tax 10 rupees per liter, 15 rupees per liter. I hope you know this. That is in case of petrol, special additional excise duty, etc. State governments generally announce as a percentage of the price. State governments announce as a percentage of the price. Center announces per liter. So when the government uses the term per liter, it is a per unit tax. Please be very careful. Surcharge and cess. Basic idea. Surcharges are additional taxes which are imposed and collected by the government whenever, right, a taxpayer crosses certain threshold. These will further reduce the income inequality. These are progressive in nature. Surcharges are imposed and collected, and there is no compulsion on the government of India to transfer the surcharges to the state government under the divisible pool of taxes. Please be very careful. Okay, cess. Cesses are additional charges or additional taxes imposed and collected. But cesses are imposed and collected with a specific objective in the mind. Specific objective in the mind. For example, Krishi Kalyana cess, right? Swachha Bharata cess, etc., etc. Right? These are cesses. And cesses which are imposed and collected by the center, right? These are separately kept, not a part of divisible pool of taxes. Done? Everybody is okay? Please do let me know. Now, important points regarding GST. Important points regarding GST. And somebody had put a comment, we should skip GST, we should skip taxation inflation and GDP. Aman Singh, why, my dear? Why? Why do you want me to skip inflation, GDP, and taxation? Do let me know. So GST has been implemented. GST has been implemented with the passage of 101st Constitutional Amendment Act. GST has the concept of one nation, one taxation, that is throughout India. Indirect taxes will be the same. GST has a dual structure in India. Dual means there are two parts to GST. CGST, which will go to the center, and the SGST will go to the state, right? That is a dual structure of the GST. GST is also a destination based tax. GST is also a destination based tax. Destination simply means the state where the the state where consumption happens, that state will get the SGST component. Is everyone okay? The state where the consumption of the product happens, that particular state will get the SGST component. Hence, this is called as a destination based taxation. Okay, my dear, right, Nitesh, have patience, I'll address your doubt. Right now, there are two main rates of GST, that is 5% and 18%. Earlier, different rates were there. Rationalization has been done. Only two rates now, 5 and 18. And some of the products which are demerit goods or sin goods, they have been kept under 40% rate. Under 40% rate, right? So there is a constitutional authority as well, GST Council. This has been set up under Article 279A of Indian Constitution by the President of India. GST Council is responsible for decision making, right, regarding, let's say, what should be included, excluded, what should be the rate, how the dispute should be addressed, etc. Right? So that is the role of the GST Council. GST Council is chaired by the Finance Minister. It is headed by the Finance Minister, and it will also have a representation from the state governments. It will also have a representation from the union territories, which will have legislature. Right? So another important point, please remember this. According to the Supreme Court judgment, the recommendations of the GST Council are not binding on the central government. The recommendations of the GST Council are not binding on the government. Now, whenever the GST Council has to take a decision, the minimum requirement is minimum 75% of present and voting. Minimum 75% of present and voting. And what do I mean by minimum 75% of votes? The total number of votes in the GST Council has been divided between center as well as the states. Center has 33% of the votes. The remaining states and union territories, again, union territories which have state legislature or which have legislature, have been equally divided the remaining 2/3 of the votes. So basically, these particular, let's say all of these participants will vote. And if you have more than 75% of the total votes of present and voting, then this can be taken as the council's decision. Okay. And the quorum requirement of the GST Council is minimum 50%. Minimum 50% is the quorum requirement. Right. So these are certain important points in the context of the GST Council. Please be very careful. Now, in addition to this, there is also one more idea, GST 80. Today, in fact, there is an article in the business line, today's business line, don't worry. The GST 80, the GST Appellate Tribunal, all the benches have become operational now. All the benches have become operational. So please be very careful. So GST 80 is a statutory body which has been set up under the CGST Act of 2017. It will be the single body, single authority to take care of all the appeals against the GST. Any disputes, let's say disputes between a taxpayer, company, right, or the tax authority, etc. All of these will be handled by the GST Appellate Tribunal. Right, and this will operationalize basically the punchline of Government of India, objective of Government of India, one nation, one forum. Because argument is earlier, please understand, earlier the state taxes were different, indirect taxes, central taxes were different. So there was CESTAT, Central Excise Service Taxes Appellate Tribunal, and for sales duty there was a different tribunal, etc. So in order to address different tribunals which used to handle indirect taxes disputes, now that has been addressed, it has been synchronized, or only one authority has been made, that is the GST 80. Okay, so principal bench will be or has been set up at New Delhi, and apart from this, there are 31 benches which have been set up throughout India. The benches will have two judicial members and one technical member who is appointed by the center and one technical member who is appointed by the state government. Everybody is okay with the GST? Done? Everybody is okay with the GST? Next, base erosion and profit shifting. Now, before I go forward, there are a couple of students who are basically pasting the same comment again and again. Windfall tax is basically a tax which is imposed by the government on oil companies. But why it is called as a windfall tax? It is called as a windfall tax because you are earning profits, you are earning more income not because of your policy, not because of your planning, but because of something that is happening in the economy. For example, Russia will attack Ukraine. Russia now, because there is, let's say, I'm talking about earlier example, Russia will now sell the crude oil to you at a discounted price. In the global market, the crude oil prices are very high. You will supply, you will purchase at a discount, you will sell it at a higher price. So you are earning profits suddenly, not because of your planning, but because of something else. On this, the government will impose a tax, windfall tax. Okay, done. Let's go forward. Let's go forward. Right, base erosion and profit shifting. Base erosion, profit shifting. Right, sir, if the items are exported below the market price, then what will be? In what context? In what context are you asking that? Okay, base erosion and profit shifting. Base erosion and profit shifting is tax avoidance policy. Tax avoidance measures which are used by the multinational enterprises. Simple, multinational enterprises. Now, these particular multinational enterprises will try to basically use the taxation policies or the loopholes in the taxation, shift the profits from one country to another country, reduce the tax liability. That is called as base erosion and profit shifting. And when these kinds of tax avoidance policies are implemented or followed, the countries or the governments across the world end up losing lot of tax money. In order to address this particular problem, the OECD grouping plus G20 grouping, India is one of them by the way, have come together and have announced and implemented a policy called as, right, the BEPS action plan. BEPS action plan. There are 15 pillars under the BEPS action plan. They have come into force already. Now, under the BEPS itself, there is one more policy which has been there in the discussion, BEPS 2.0. Under BEPS 2.0, there are two pillars. Pillar 1, right, basically talks about taking away the revenues or the profits generated by the multinational enterprises and giving it back to the countries where the profits have been generated. Part of the profits will be taken away and will be given to the countries where the profits have been generated. And there is one more, Pillar 2. Under Pillar 2, we will ensure that across the globe, the effective corporate tax rate will be a minimum 15%. Across the globe, the global minimum corporate tax rate of 15% will be ensured. Right, so these are the important points under the base erosion and profit shifting 1.0 as well as 2.0. This is an update. Very recently, there has been a carve out. Very recently, there is a carve out. Carve out means exemption that has been created within the BEPS 2.0. That is, the American companies will not be targeted. American companies will not be targeted under the BEPS action plan now. That is BEPS 2.0. This was there very recently in the context of current affairs discussion. Okay, let me go forward now. Right? Capital gains tax, security transaction tax, and income tax. One by one. What do you mean by capital gains tax? You buy an asset and you sell the asset. You buy and you sell. If the price of the selling, that is the selling price, is greater compared to the acquisition cost, then the government will simply say you have made capital gains. You have made capital gains. On these capital gains, the government will impose and collect a tax. And that, my dear, is called as capital gains tax. Is it okay? I'll repeat the statement. You buy an asset. Asset could be a movable asset or an immovable asset. For example, you buy home, you buy land, you buy jewelry, you buy gold, right? You buy other types of assets, paintings, etc. Movable and immovable. So when you buy, right, there is a price that you pay. When you sell, there is a price you get. So the price that you have paid, that will be adjusted for inflation. And if there is still a gain, right, if you're making a gain, that is called as a capital gain. On the capital gain, the government will impose a tax and collect a tax, that is called as a capital gains tax, CGT. Now from one asset to another asset, what is the rate? It varies. From one asset to another asset, is it a short-term capital gain or a long-term capital gain? That will also vary, right? So there is no uniformity per se in terms of, right, let's say the categorization, the time period or the holding period, etc. in the context of capital gains tax. Done? Okay, right. Let's go forward now. Securities transaction tax. This was also there in the newspaper. Securities transaction tax. What is a securities transaction tax? In the market, let's say equity market, right? In the market, you will buy and you will sell the securities. That is, you're going to trade the securities. So when you trade the securities, on the price, the government will impose a tax and collect the tax, and that is called as securities transaction tax. It's a type of a direct tax, by the way. So on the stock exchanges, when the trading of the securities is done, government imposes, collects the tax, that is STT. It has been introduced in the Finance Act of 2004. In fact, there is a petition in the Supreme Court asking the Supreme Court to direct the government to withdraw securities transaction tax. That hearing is happening. You don't worry about it. Basically, here on the value of the security, for example, you purchase a share, you purchase, let's say, certain types of derivatives. The government will impose a tax on you, which is called as a securities transaction tax, and collect it from you. In fact, there was an announcement in the budget in the context of the derivative market and the STT, that is the futures and options market, and the STT applicable on them. Done? Okay. And finally, Income Tax Act. Income Tax Act of 2025 has come into force. Please be very careful, right? The Income Tax Act covers, right, let's say the individuals, that is salaried individuals such as, right, you and me, right? Let's say certain types of individuals who are earning other sources of income apart from or in addition to or without even the salary, etc. The companies as well as the Hindu undivided families, etc. All of them are covered under the income tax. Earlier, Income Tax Act of 1961 provisions were applicable. Now the Income Tax Act of 2025 provisions are applicable. Now, what is the relevance to you? What is the importance to you? Here is the importance for all of you. There are a lot of provisions under the Income Tax Act you are supposed to know. For example, there is this idea, minimum alternate tax. In the books that you have referred to, revised and memorized, you would also have memorized what are the provisions under the Income Tax Act of 1961, which UPSC has the habit of asking, by the way. But please understand, now these particular provisions have changed. Please make a note of this. Minimum alternate tax. What is the provision under the Income Tax Act of 2025 that covers minimum alternate tax? It is covered under section 2061 of Income Tax Act of 2025. Is it okay? It is covered now under section 2061 of Income Tax Act of 2025. Please update this. But what is this minimum alternate tax? Minimum alternate tax will cover or will target zero tax companies. That is those particular companies which generate profits, that is book profits, but will use a lot of tax deductions and will end up paying 0 rupee taxes to the government of India. These companies were called as zero tax companies. The government of India, that is when Mr. Rajiv Gandhi was the Prime Minister, they introduced the concept of minimum corporate tax to target these kind of companies. And the right tax rate was notified, withdrawn, again notified, and right now it is applicable, by the way. Right? So under this, the target is of zero tax companies. They are generating profits, but they are not paying taxes to the government. Right? So it was withdrawn as well as again reintroduced from 1st April 1997 in the recent budget that was announced. Essentially, it is reduced. Earlier it was 15%, now it has been reduced to 14%. Earlier it was 15%, now it has been reduced to 14%. Please remember this. There is one more important piece of rules for you. GAR, General Anti-Avoidance Rules. Here also the rules under the new Income Tax Act, the provisions number is different. Please remember this. What is the General Anti-Avoidance Rules? There are many taxpayers, in order to avoid the taxes, will enter into certain types of arrangements. And these kind of arrangements are mainly done, I repeat, are mainly done to avoid the taxation. So the tax officials will use the GAR, that is the framework of GAR, identify these agreements, and they will classify them as impermissible avoidance arrangements. They will classify these kind of arrangements as impermissible avoidance arrangements. And once you are classified, or once this transaction is classified as IAA, whatever tax benefit was given to you earlier, this tax benefit will be withdrawn. Means you enjoyed a tax break, now those taxes you will have to repay. This is basically done using the framework of GAR. The committee which recommended the implementation of the GAR is Partha Sarathi Shome Committee. It has come into force from 1st April 2017. And please understand, under GAR, the focus is always on the substance of the arrangement, not the form of the arrangement. In fact, the same statement was used by Supreme Court of India very recently in the context of Tiger Global case. In the context of Tiger Global taxation case. Focus is always on the substance of the arrangement, not the form of the arrangement. You could have entered into an arrangement, which looks legit, which looks very, legal, which will provide you the tax benefit. But the substance of the arrangement for you is to mainly avoid taxation. So in such cases, the tax benefits that you enjoyed will be withdrawn. You will have to pay the taxes. So under the new Income Tax Act 2025, the GAR provisions are covered under Chapter 11. Is it okay? Under Chapter 11, please make a note of this as well. Please make a note of this. Okay. Now, a couple of more concepts regarding taxation. Double Taxation Avoidance Agreement, DTAA. I believe there was one person continuously they were typing what is DTAA. I'm explaining it now. What is Double Taxation Avoidance Agreement? DTAA basically is an agreement between, let's say countries, let's say two countries, many countries, etc. But objective is simple. Whenever, let's say investments are done, whenever incomes will flow, these investments will generate profits. The profits should not be targeted by both of the countries and should not be imposed with taxation. There should not be double taxation on the same source of income. In order to avoid from this, in order to ensure that this will not happen, countries sign double taxation avoidance agreements, DTAA. Treaty signed between countries. Agreement could be comprehensive, covering all the types of investments, or can be very limited. They will cover only, let's say, investments are done in services sector, investments are done in manufacturing, etc. So the treaty could be very comprehensive or could be very limited as well. So under this, the double taxation will be avoided. And let's say there is a double taxation. In such cases, the credits from one of the countries is provided to you so that you are not suffering because of the double taxation. Under the new Income Tax Act, remember this, under the new Income Tax Act, the provisions of double taxation avoidance agreement are covered under Section 159. Under Section 159. Done, everybody is okay? Next one is Advanced Pricing Agreement, APA, Advanced Pricing Agreement. What is this APA? Let's say you want to, let's say export something to foreign country. Now you are not clear regarding what is the tax implication. And the situation is also a bit complicated if the purchaser, that is the buyer from you, is a related company. So in order to have clarity regarding all the taxes that are applicable, you think the tax rate is 5%, but the customs duties or the taxation authorities might decide it is 20% because of this. In order to get clarity so that there is no dispute further down, further, right, let's say later, there is, right, an advanced pricing agreement. That is, under this particular agreement, which was introduced under the Finance Act of 2012, the resolution is provided regarding the transfer payment. That is, in such cases, there is an agreement which is signed between the parties, and right in the agreement, the company is going to provide details in the sense, if I'm going to sell the product, transfer price means the money that you receive after transferring a product. So regarding the transfer of the product, what is the pricing methodology, right? How I'm going to determine the price of the product, etc. So these kind of details are provided by the, right, let's say the participant or the companies, right, to the tax authorities. That is called as advanced pricing agreement. Okay. APAs are enacted by CBDT, Central Board of Direct Taxes, with the taxpayers. In addition to this, couple of more small concepts under taxation. There's a term called as tax planning. Tax planning basically refers to using certain provisions which have been announced by the government legally to reduce the taxes. Is it okay? Right? You are using the provisions announced by the government only and you are reducing the tax burden. That is called as a tax planning. Then there's a tax avoidance. You are exploiting the loopholes in the taxation system to reduce your tax burden. That is the tax avoidance. Then there is a tax evasion. You are using illegal methods to reduce the tax burden. That is tax evasion. Then there is a tax deduction, tax exemption, and tax rebate. A lot of you are confused between all the three. Tax deduction, exemption, and a rebate. Tax deduction basically means, right, you are incurring certain expenditures and these expenditures can be deducted from the income so that, right, your tax liability will be lower. Exemption, right, basically understand this, you are earning income. This income is not counted as a part of taxable income. Then there is a rebate. You are paying the taxes. These particular taxes are given back to you. These are called as tax rebates. Okay. And finally, tax elasticity and tax buoyancy. Tax elasticity and tax buoyancy. Tax elasticity simply means when you are changing the tax rate, as a result of this, what is the change in the taxes collected? When you're changing the tax rate, as a result of this, how much is the change in the taxes collected? That measurement is called as tax elasticity. And there is a tax buoyancy. Tax buoyancy measures response of the taxes collected when there is a change in the GDP. When the GDP changes, for example, India's GDP increases, don't you think automatically that should lead to higher amount of taxes collected by the government? That is tax buoyancy. Right? So that is the reason very often in the newspaper you will come across the statement of the finance minister that the tax buoyancy should be more than one. We should be having higher tax buoyancy. And generally, in case of the income taxes now, it is higher. In case of indirect taxes also, it is higher than one. Done? Can I move on to the next chapter? Couple of more chapters, don't worry, we'll cover and we will finish. In another 40-45 minutes, we'll finish all the things that we are supposed to cover, by the way. Right? Small chapters now. Next one, fiscal policy. Right? We are covering fiscal policy, by the way. In fiscal policy, we have covered taxation. Now, it is the turn of budgeting. It is basically the turn of budgeting. Right? So, first and foremost, please understand the term budget is not mentioned in the Constitution of India. It's not mentioned in the Constitution of India. What is mentioned in the annual financial statement under Article 112? Right? Annual financial statement under Article 112. Now, when you talk about the budget fundamentally is divided into two types of accounts. One is called as revenue account. Second one is called as capital account. Revenue account and capital account. Revenue account will have total expenses incurred by the government as well as total receipts. I'm using the term receipts which represents income. So total expenditure and total receipts during the day-to-day government activity. During the day-to-day government activity. That is, in simple terms, on day-to-day basis, because of these, government will spend money, government will collect money. Another very important point, under the revenue account, there is absolutely no change in assets or liabilities of Government of India. There is no change in assets or liabilities of Government of India. That is revenue account. Alright, under the revenue account, there are two types, revenue receipts. Revenue receipts are further divided, right, into tax receipts as well as non-tax receipts. Tax receipts are direct taxes, indirect taxes. Non-tax receipts are, right, let's say charges and, right, let's say the penalties and charges collected by the Government of India. The dividend amount collected by Government of India, right, the interest payment collected by the Government of India, etc., etc. So revenue receipts and revenue expenditure. Revenue expenditure example, the Government of India will announce a, let's say, welfare scheme. Government of India will pay interest on the loans that they have taken. The Government of India will announce a scheme for welfare of the farmers. Right? All these are basically the examples of revenue expenditure. Next, capital account. Right? Under capital account, there are two components. But what is the meaning of the term capital account? Capital account simply refers to the expenditures as well as the receipts which are connected to the changes in the assets or the liabilities of Government of India, which are connected to the changes in the assets or the liabilities of Government of India. Please remember. So under the capital, there is a change in asset or liability. In the revenue, there is no change in asset or liability. Now, in the capital, there are two types again, capital receipts, capital expenditure. Under capital receipts, examples are government will recollect the loan that it has given earlier. The government will sell the assets. The government will borrow money, etc. But more importantly, please remember these arrow marks. Please remember these arrow marks. Under the capital account, that is a capital receipts, assets will decrease, liabilities will increase. Assets will decrease, liabilities will increase. Whereas in case of capital expenditure, where government will spend money, create assets. Government will give loans, etc. The assets increase and liabilities decrease. Is everybody okay? Please remember this kind of a relation. UPSC has the habit of asking questions in this. Now, associated with this, there are different types of deficits. There are four important ones which are calculated and published by Government of India. One is the revenue deficit. Revenue deficit essentially is the difference between the revenue expenditure and the revenue receipts. That is, under the revenue account, you are spending more compared to how much you are earning. That is revenue deficit. According to the original FRBM, you are supposed to reduce the revenue deficit to 0% of 0% of GDP. 0% of GDP. Then there is effective revenue deficit. Why it is called as effective? Argument is there was a committee which was set up, Rangarajan committee. The Rangarajan committee looked at the revenue deficit and found there is a problem. Problem is GCCA, Grant for Creation of Capital Asset. It is a grant which is provided by the center, let's say, to a state, using which asset is created. So when you talk about revenue, under the revenue, you are simply saying there is no asset creation. There is no change in asset. But please understand, under the grant for creation of capital asset, there is a change in the asset, but this is kept under revenue because the assets of the state government will change, not that of central government. That's the reason this is kept under the revenue side. So the committee was, doesn't matter, it is related to asset. It is related to asset. So that is the reason what we have done is, from the revenue expenditure, I will subtract grant for creation of capital asset, which basically now shows how much is the excess expenditure I am doing under the revenue account for consumption purposes. How much is the excess expenditure for consumption purposes? Done. Third one is the fiscal deficit. In simple terms, It represents the borrowings done by the government. Borrowings are done by the government this year. So fiscal deficit represents the total expenditure minus non-debt creating receipts, which is nothing but the total revenue receipts plus non-debt creating capital receipts. Revenue receipts plus non-debt creating capital receipts, right? So difference between this is essentially the borrowings done by the government in this year, and that is called as fiscal deficit. Then there is also primary deficit. What is the basic idea for primary deficit? Fiscal deficit minus interest payment. The basic idea for primary deficit is whether you are borrowing money to take care of your current year expenditure or your past year activity. Very simple. In this year, you are borrowing money, but for what purpose? Are you using this money to take care of your current year expenses or right to take care of your past year activity? That information is not provided in the fiscal deficit. But in the primary deficit, what I do is I will subtract the interest payment from the total amount of borrowings. Logic is that if I remove the interest payment, which is basically the payment for the loans that you have taken in the past, that basically means the difference between this is the amount of borrowings that I'm doing for taking care of the current year expenditure. That is provided in the primary deficit. Done? Right? So these are the different types of deficits. Now, what is the important provisions of the FRBM Act? There is a FRBM Act as well. Please focus on that as well. So FRBM Act 2003. The objective under that was to enforce, right, or basically introduce the concept of accountability, transparency, intergenerational parity. Intergenerational parity on the expenditure or the practices, financial practices of the government of India. Under the FRBM Act, the objective was to reduce the fiscal deficit to 3% of GDP by 2008 and 9. It was to reduce 0%, RD to be reduced to 0% of the GDP by 2008 and 9. Objective was simple. If you reduce RD to 0 and FD to 3%, it means you're borrowing but for creation of assets. Not for consumption purposes, but for creation of assets. That was basically the objective under Fiscal Responsibility and Budget Management Act. And the FRBM Act also mandated that the government of India, the Reserve Bank of India should not be purchasing the bonds of government of India directly from the government of India. That is, the primary market participation in the government bonds should not be done by RBI because it will lead to more money supply which contributes to inflation. Right? So primary market participation not allowed. In addition to this, right, every year when the budget is announced, the government has to come out with macroeconomic framework statement. That is, the government has to provide the overview of whatever is happening in the economy. Government has to come out with medium-term fiscal policy statement. That is, the government has to provide information regarding what will be, right, let's say the targets, what will be the targets for FD, RD, etc. for the next 3 years. And the government also has to publish fiscal policy strategy statement. That is, the government has to provide what will be the strategy areas targeted by the government in the next 1 year, right? So the government later, when Mr. Arun Jaitley was the finance minister, the government also set up the NK Singh committee or else FRBM review committee, Fiscal Responsibility and Budget Management Review Committee. So this particular FRBM review committee has recommended certain changes. That is, instead of targeting only FD and RD, we should target the debt to GDP ratio. In fact, the government of India is starting to follow this, and it has started to follow this now. Debt to GDP ratio. The committee recommended that the total target of debt to GDP ratio for the center plus state should be fixed at 60% of GDP. 60% of GDP. Of this, 40% target was given to the center and 20% target was given to the states. Right? We have not been able to meet the target. That's a different issue. Independent fiscal council should be set up by the government of India. not set up by the government of India, by the way. Right? Individually, the targets were given for the central government to control FD as well as RD till 23. We have not been able to meet the target, and it has also codified in the sense under what circumstances the escape clause can be initiated. That is, the government is allowed to cross the FD target. Government is allowed to cross the FD target by 50 basis points, not by 5 basis points, 50 basis points. But under what circumstances? That has been mentioned in the FRBM review committee. For example, if the economic collapses by so much percentage, if there is issue of national security, if there is a collapse of agriculture sector, if there is a war that is happening, etc. So under these circumstances only will the government be allowed to use the escape clause, that is exceed the fiscal deficit target. Done. And the other point associated with the budgeting is this: the government of India has already shifted the fiscal anchor. What is a fiscal anchor? The government of India until now used to formulate a policy keeping the fiscal deficit at the center. The government used to focus on fiscal deficit and decide the policy. Government now says, not required, we will change the anchor, rather we will use the debt of the government of India. Debt of the government of India, debt to GDP ratio of government of India. Right? The government of India has kept a target of reducing the debt to GDP ratio to 50%, 50% of GDP by end of financial year 2031, and with the flexibility of 100 basis points, that is 1%, 50% plus 1, 50% minus 1, that's a target. But when I say total debt of the government of India, it includes all of these liabilities of government of India. So the target is to reduce this to 50% of GDP by 2031. And finally, within this particular chapter, Finance Commission. Please focus on the 16th Finance Commission. Question can be asked. Potential is very high from the 16th Finance Commission. What are the important points? Let's understand. Finance Commission is a constitutional body set up under Article 280. I'm pretty sure all of you know this. The composition of the Finance Commission is 1 plus 4, chairperson plus 4 members. Then there are multiple terms of references. The most important term of a reference for a Finance Commission is to recommend tax devolution formula. Tax devolution formula. That is, the central government will collect the pan-India taxes, no cesses, no surcharges, and take these particular taxes, that is called as divisible pool. This is called as divisible pool. From the divisible pool, now how much money will be allocated to the states, how much will be allocated to the center, and once the allocation is done to the states, how much will go to each of the states. The first recommendation between the center and state is called as vertical devolution, and amongst the states is called as horizontal devolution. So that is the most important recommendation that is provided by the Finance Commission. In addition to this, how do you augment the consolidated fund of the states? That is a term of reference. On what basis the grants should be issued to the states? That is a term of reference. Any other measure suggested by the government, that is also a term of reference. Done? Now, important points regarding the 16th Finance Commission. The recommendations of 16th Finance Commission are applicable from 2026 to 2031. Remember this. Who is the chairperson? Mr. Arvind Panigaria. Vertical devolution formula has remained same as it was in the 15th FC, 41%. Horizontal devolution formula, these are the parameters: population of 2011, demographic performance, area, forest cover, GDP distance per capita, that is also income distance, and contribution to GDP. These are the parameters which have been considered in recommending the horizontal devolution formula. In addition to this, a grant in aid of total 9.47 lakh crore rupees have been recommended. FD target that has been recommended is 3.5% of GDP by financial year 2031, and the total debt for the center and states recommended is 73%. And I'm using the term recommended because please understand the recommendations of the Finance Commission are not binding on the center. These are not binding on the center. These are advisories in nature. Okay. The states must review their subsidy expenditure, and finally, the states should also pursue the privatization of the discoms, or let's say the distribution companies in electricity sector. These are the important recommendations from let's say the Finance Commission, and we have covered. Congrats, by the way. We have revised taxation as well as budgeting. Now, couple of more concepts, national income, small chapters. Now let's start. Everybody is okay? Please do let me know. Everyone is okay? Can we continue? Those present, please confirm. If you say, sir, stop, don't take any more, we are fed up, I'll stop the discussion. No problem for me. If you say, no, sir, no issue, continue, and I'll continue. And before I continue, if you have liked the discussion that we have done so far, do not forget to hit the like button. If you're yet to join the Unacademy IS YouTube channel, please hit the subscription button right now. Okay, let's go forward. Okay, let's continue. Some more concepts we are going to complete. Don't worry. Most of the larger concepts are done now. Small concepts. Let's discuss national income. Let's revise important national income aggregates. Okay, national income aggregates. First one, GDP, gross domestic product. Most important one, GDP, gross domestic product. What is the meaning of a gross domestic product? It represents the market price of all the final goods and services which are produced within the territory of a country. It represents market price of all final goods and services which are produced within a territory. In case of India, this is published by MOSPI, Ministry of Statistics and Program Implementation, and under MOSPI, specifically, it is NSO, National Statistics Office. Okay, so when you calculate GDP, only the final goods and services are considered. Transfer payments are not considered. Remember this, transfer payments are not considered. The market price of goods which are resold, market price of the goods which are resold, not considered, etc. All these are the important points. Please keep it in mind. Okay, so there are three methods to calculate GDP. One is the income method, where you take the sum total of all the factor incomes. Then you have expenditure method, where you take the sum total of the expenditure on the final goods and services which are done by the government, households, as well as companies, C plus I plus G. And from this, you subtract imports and you add exports, C plus I plus G within the bracket X minus M. That is to ensure that when you talk about GDP through consumption method, you're going to count the final goods and services which are produced in India, consumed in India, and consumed outside India. That is basically the expenditure method. And third one is the production method or the output method. Under this, the focus is simple. You take the market price of all the goods and services and you subtract the market price of intermediary goods. That's it. You get the GDP through production method. Done. The latest change in the context of the GDP discussion is the base year until now was 2011 and 12. Now this has been shifted to 22 and 23. Now this is GDP. Then there is a GNP, gross national product. GDP is a geographic concept. The production is done in India. You simply count it as a part of India's GDP. But the GNP is a nationality concept. In GNP, the focus is on who is producing it. If it is being produced by the resident of India, whether the resident is within India or outside India, does not matter. You count it as a part of India's GNP. So GNP, gross national product, it is a market price of all the final goods and services which are produced by residents of India. Whether the production is done in India or outside India does not matter. How do I get this number? take GDP, gross domestic product. From GDP, simply subtract all the factor incomes which are generated by non-residents, and you add all the factor incomes generated by residents of India, but these incomes are generated outside India. Very simple idea. Please don't overcomplicate it. You have GDP. In GDP, you have the factor incomes generated by residents of India who are working in India plus non-residents who are working in India. So remove, right, the factor incomes generated by non-residents and add factor incomes generated by residents of India, but these are generated outside India. Right? So that will give you the gross national product. And technically, these two components, that is a factor incomes generated in India by non-residents and the factor incomes generated by Indian residents but abroad. These two components are called as net factor income from abroad. Net factor income from abroad. Everybody is okay with this? Everyone is okay? That is GNP. Now next one is NDP. MOSPI has very recently stated that rather than GDP, they want to shift to NDP. This is important, by the way. Right now we are focused on GDP. They want to shift to NDP. What is the logic? GDP will simply tell you the market price of all the final goods and services produced in India. But some of these particular goods will be capital goods. Correct? In the final goods, you will get a classification. One is the consumer goods and the other one is capital goods within the final goods, by the way. Right? So when these particular capital goods are produced, some of these particular capital goods will be added to the existing capital, will be addition to the existing capital. And some of these particular capital goods will be replacing the old, right? That is the old worn out capital. That is machinery. Some machinery is old. Now you will throw it away. You will purchase a new machinery this year. So when you calculate GDP, this idea, this differentiation is not done. How much of the capital is replacing existing capital? How much is addition to the existing capital? All of this information is not given to you under GDP. But if you want to continue to produce the same quantity, if you want to increase the production, etc., you will have to keep on replacing old worn out capital with the new capital. And that is basically concept of depreciation. That is basically the concept of depreciation. Everybody is okay? So depreciation is not removed from the GDP number, but we need to adjust it. That is exactly what is done under NDP, Net Domestic Product. It represents the market prices of all the final goods and services which are produced, but after adjusting for depreciation. Because depreciation has to be removed in order to understand how much is, right, let's say the final goods and services which are purely supplied to the market and it is not replacing. Everybody is okay? Depreciation simply means reduction in the value of the asset. Reduction in the value of the asset because of wear and tear, because of repairs, because of, right, let's say replacement, etc. Okay, so formula is simple. NDP is equal to GDP minus depreciation. Everyone is okay? Can I move on to the last one? Last indicator, NNP. NNP, Net National Product. It represents the market price of all the final goods and services produced by the residents of a country after adjusting for depreciation. After adjusting for depreciation. That is, what is the market price of all the final goods and services produced by the residents of India? Whether they are in India or outside India doesn't matter. But remove depreciation from that. Argument is simple. Depreciation does not represent addition to the economy because it is replacing something in the economy. Right? So how do I get it? NNP is equal to GNP minus depreciation. GNP minus depreciation. And within NNP, please remember, there is one form, NNP at factor cost. Please remember this. NNP at factor cost. The NNP at factor cost is considered as the purest form of income. Can be asked in the prelims examination. Please be very careful. NNP at factor cost is considered as a purest form of income. Why? Logic is simple. Because when you talk about market prices, when you calculate GDP, GNP, etc., by default, these are at market prices. By default, all of these are at market prices. But the market prices are derived by adding the indirect taxes and subtracting subsidies from the factor cost. Everybody is okay with the formula? You add indirect taxes and you subtract subsidies and you get market prices. So when you have market prices, does it represent the factor incomes earned by the residents? Does it represent, right, only the factor incomes earned by the residents? No. There is indirect taxes, there is subsidies. So when you adjust for both of them, when you adjust, that is like this, factor cost plus indirect taxes minus subsidy is equal to market price. Now take both of them, transfer it on the other side. Factor cost is equal to market price minus indirect taxes plus subsidies. Can I simply say now, when I calculate NNP at factor cost, it represents only the factor incomes. Everybody is able to follow? It represents only the factor incomes. So factor incomes are represented when you calculate at factor cost. So that is the reason NNP, purest form of income generated by the residents. Okay, couple of more important concepts. Real and nominal GDP. When you calculate GDP at the prevailing prices, nominal GDP. When you calculate GDP with the base year prices, real GDP. GDP deflator. GDP deflator is also referred to as implicit price deflator. Why? When you calculate CPI, WPI, etc., can I simply say you're taking a basket? You're taking a basket. Whereas when you calculate GDP, that is nominal GDP and real GDP, you're not taking a basket of limited goods and services. You're covering all the final goods and services produced. All the final goods and services produced. That is the reason when you calculate nominal GDP by real GDP, you get for the whole economy, what is the rise in the price level. That's the reason GDP deflator is also considered as a implicit price deflator, and it is right one of the most accurate representations, much better than CPI and WPI in measuring inflation. Okay. Next, potential GDP. What do you mean by potential GDP? At full employment, by utilizing all the resources the most efficient way, what is the production that can be achieved? Is everybody able to understand? At full employment means what? You are providing jobs for all those who are searching. All those who are searching for a job is given a job. So at the full employment, by utilizing the resources most efficiently, what is the maximum GDP that you can produce? That is basically called as potential GDP. Right? So there are two terms, deflationary gap and inflationary gap. When the potential GDP is greater than the actual GDP that you have achieved. When the potential GDP that you can produce, maximum production that is possible, is greater than what is actually achieved in the economy, this is called as deflationary gap. And when the output that is actually produced is greater than the potential GDP, this is called as inflationary gap. Okay. Then there is a recession as well as a depression. Recession means for 2 consecutive quarters when the GDP growth rate is negative. Depression means when there is a severe recession. For example, American standards, they simply say if the GDP in a year crashes by more than 10%, they will consider this as a depression. Okay. Right. So these are certain important points in the context of national income. Can we move on to the next one now? Those present in the session, please confirm. Can we move on to the next one? So what is left out? Before you start rolling your eyes, rubbing your eyes, rubbing your head, etc., what is left out? Inflation, a small chapter. After that, right, employment, unemployment, important points. And after that, right, industries. Right, and finally, some points regarding planning. right? So another half an hour, we will be completing all, by the way. Another half an hour, we will complete all. So have patience. I know a lot of you are frustrated. A lot of you want to drop preparing for UPSC. By the way, if you are able to sustain 3 hours, congratulations. Congratulations from my side. Right? You are very well, right? Let's say ready to at least sit for 3 hours with attention in the UPSC examination. Okay, let's go forward now. Let's go forward. Couple of more things, then we will close the session. Inflation. What are the important points in inflation? Inflation simply means there is a rise in the price level of basket of products. That is, there is a basket. Basket means collection. The price of this particular basket keeps on increasing. This is called as inflation. Done? This is called as inflation. Now, how do I identify inflation? How do I classify inflation? One classification based on the rate of inflation. Rate of inflation. There is a creeping rate of inflation, walking rate of inflation, galloping, and hyper. Creeping, walking, galloping, and hyperinflation. What's a basic idea? Creeping means whenever inflation rate is up to 3% per year. Walking means when it is more than 3% up to 10%. Third one is galloping, where more than 10% but up to 50% again per year. And finally, right, hyperinflation, when the inflation rate per year, per month, when the inflation rate is very, very high, uncontrollable, more than 10%, right? Up to 50%, up to 50% per month. So in such cases, this is called as hyperinflation. Done. So based on the rates, this is a classification. Okay. Next, inflation can be caused because of supply side factors as well as demand side factors. When the supply side factors contribute to inflation, we call it as cost push inflation. When it is because of the demand side, we call it as a demand pull inflation. For example, in the current affairs, all of you will agree, the prices of crude oil, the prices of vegetables, the prices of edible oil, the prices of, right, let's say, the pulses, vegetables, etc., they are contributing to inflation. Right. So anyways, so cost push inflation, for example, when the cost of raw material goes up, when the interest rate on the loans taken by the manufacturer goes up, when the government imposes higher indirect taxes, right? When there is a sudden supply shock, for example, let's say there is a flood, there is a, right, let's say drought like situation. These are supply shocks, right? So there can be hoarding as well. Hoarding means the suppliers, right, the middlemen are storing more than what is actually allowed by the government under Essential Commodities Act. Right, Essential Commodities Act. There is a Essential Commodities Act of 1955. Very recently, it was there in the newspaper as well. So the government of India has notified a product as an essential commodity. The middlemen will store more than what is actually allowed under the law. So this will create a shortage or a scarcity in the market. That is essential, right? Let's say hoarding activity. So hoarding activity, cartelization, etc. Cartelization, all of you heard of OPEC? Anybody in the class who is preparing and will ask me, sir, what is OPEC? Do let me know. Right? Very recently, OPEC has been there in discussion for so many things. But anyways, if OPEC will decide to cut the oil production, cartelization, cartel means, right, a group of producers. So OPEC will cut down the production, automatically it will increase the market prices of the crude oil. And because India is import dependent, Indian rupee is depreciating, etc., that will also contribute, right, to the import inflation as well. All of you remember there is a term called as imported inflation. Rupee depreciation, right, the cost of imports increasing, all of that will contribute to imported inflation. Then everybody is okay, right? So these are basically the factors which contribute to cost push inflation. Next, demand pull inflation. How can there be a demand pull inflation? Let's say the government will announce every month I will transfer 500 rupees into your bank accounts. Right? A Revdi culture. All of you have heard of this? State government elections, etc. Right? So the state government will simply say, I will give you 500 rupees every month. You purchase goods and services. So these kind of, let's say, right, the policies which will lead to more money supply. Government will reduce the income tax rate, which will lead to more money supply. RBI will reduce interest rate, which will lead to more money supply. Right? So please understand, when there is too much of money with the people, all of us want to purchase goods and services. As a result of this, the aggregate demand in the market will increase. And when the aggregate demand increases and the supply cannot match the demand, that will automatically lead to inflation in the market. That will automatically lead to inflationary trends in the market. So demand pull and cost push. Now, how do we measure inflation? There are two measures. One is WPI, second one is CPI. WPI stands for Wholesale Price Index. CPI stands for Consumer Price Index. WPI measures the change in the market prices of basket of goods in the wholesale market. Wholesale market simply means where buying and selling happens in large quantities. And right, the buying and selling happens between traders, between companies and middlemen, etc. That is wholesale market. Now the Office of Economic Advisor, OEA, Office of Economic Advisor is responsible for publication of WPI for every month. Yesterday itself it was there in the newspaper, by the way. Right, so what is the base year for WPI right now? Right now it is 2011 and 12. The basket has 697 goods, only goods, by the way, right? And the weightage for the manufactured products is the highest, 64%. Fuel and power has around 13%, and the primary articles has around 23%. Right now, this is basically the composition of the WPI. Government has set up a committee. If you're writing exams next year as well, I'm pretty sure by that time this will be revised. But what has been revised? This has been revised, CPI. This has been revised, that is CPI, Consumer Price Index. The Consumer Price Index basically measures inflation at the retail level. It measures inflation at a retail level. That is in the market where individuals purchase and sell, individuals purchase the goods and services. That is basically CPI. Now listen to me very carefully. Earlier we had CPI IW, we had CPI UNME, and we also had a CPI agriculture labor or rural labor. Right, so we had these kind of CPIs to measure inflation, that is retail inflation. But there was a committee set up, right, that is Rangarajan committee. This particular Rangarajan committee recommended that neither the basket is same for all the three, nor the base year is same, nor the weightage is same, etc. So what was the committee recommendation? The committee recommended that we should not use these as indicators of retail inflation. That is the reason the Government of India today publishes CPI IW, yes. CPI UNME has been discontinued. CPI AL is also published, but these are not used as indicator of retail inflation. Rather, we have CPI urban, CPI combined, and CPI rural. The base year for CPI combined until now was 2012, and this has been revised to 2024 now. This has been revised to 2024. Right, so CPI base year revised. Right, the publication of CPI is done by NSO, National Statistics Office, which functions under Ministry of Statistics and Program Implementation. Right, this particular basket has right latest one. The those particular students will simply try to correct me, sir. The CPI basket has 299 goods and services. That was with the base year of 2012. Now the base year has been changed to 2024, and the basket of goods and services, there are 358 goods and services. Right, and the one which has the highest weightage, is the food and beverages, 36.8%. And another very important point, please make a note of this. In WPI, all the 697 goods are divided into three groups. Correct? Simple idea. In WPI, all the 697 are divided into 3 groups. So in case of CPI, the CPI, all the 358 goods and services are divided into 12 groups. Can be asked in the UPSC Prelims, please be very careful. All the 358 are divided into 12 groups, right? So there under WPI, 3 groups, under CPI, 12 groups. Done? So these are certain important points. Next, measurement is done. Now, flexible inflation targeting. FIT, flexible inflation targeting. What is the concept of flexible inflation targeting? There was an agreement, monetary policy framework agreement. We have discussed this earlier as well. Monetary policy framework agreement which was signed between the Government of India as well as the Ministry of Finance back in the year 2015. According to this, the government will consult RBI, and then decide a target rate of inflation which has to be followed by or which has to be maintained by Reserve Bank of India. Done? Right? So, this is generally decided for 5 years. We have completed 2016 to 2021, 2021 to 2026 over now. So, 26 to 31. Third round of flexible inflation targeting is being implemented from 1st April 2026. Right? And what is the target? Target is still the same, 4% headline CPI with plus or minus 200 basis point. And please remember, this particular composition etc. has been provided under section 45 of RBI Act. Done? So headline CPI is targeted and that is 4% plus or minus 200 basis points. Now, couple of more concepts under inflation. Headline and core CPI. What is headline and core CPI? Headline means you're taking the complete basket and you're calculating inflation. Headline. Core means from the basket you are removing some of the goods whose prices are unstable, whose prices are short-lived. For example, food and fuel. Food and fuel. And then you calculate inflation, that is core. There is a deflation and disinflation. Deflation means the price levels are falling down. The price levels are falling down. Right? The basket prices are falling down. That is deflation. Disinflation means there is inflation rate, but the inflation rate is slowing down. Is everybody okay? So deflation means prices are falling, prices are contracting. Disinflation means prices are expanding but at very, very slow rate. That is disinflation. Then there is a stagflation as well. What is a stagflation? It's a situation wherein you experience very high inflation rate, high unemployment rate along with a stagnated growth. And this is exception to a Phillips curve. This is exception to Phillips curve. Because that curve recommends that, or that curve basically says that when the inflation rate is higher, unemployment rate is low. And when the inflation rate is low, unemployment rate is higher. Inverse relation. But this is exactly opposite of that. High inflation, high unemployment rate, stagnated growth. That is basically stagflation. Now, before I move on to the next concept, let me ask you one more question associated with inflation. Can anybody tell me what is the meaning of suppressed inflation? Suppressed and open inflation can be asked looking at what is happening in the current affairs. Suppressed inflation, and open inflation. In the context of, let's say, crude oil prices, in the context of, let's say, many other commodity prices which are subsidized by Government of India. These kind of statements can be used. Okay. Suppressed, I'm using the term suppressed, hidden. There is also a term hidden. They will use the technical term is hidden. Hidden means basically what is happening is the government is actually suppressing the prices by subsidizing. Government is controlling prices, providing the subsidies, keeping the market prices artificially low. In that case, the inflation rate, that is the market price, is not a true representation of the market prices. Whereas, right, if it is an open inflation, right, basically the government will withdraw all the policy support, market forces will determine the prices, and automatically the market prices will be higher. That will be true representation of inflation. So that can be asked in the context of government controlling crude oil prices, that is the fuel prices in India. Anyways, let's go forward. Right, couple of more concepts. Don't worry. Next chapter I want to cover is employment. Employment, important area. Okay, employment. So whenever you talk about employment, let's start with the basic idea: total population. Total population is fundamentally divided, again economics wise, is divided into two parts. One is the labor force. Labor force is that part of the population which is, right, willing to work, which is willing to work. Now the population which is willing to work is further divided into two parts, right? It is further divided into two parts. One is employed and the other one is unemployed. Employed population is that part of the population which is willing to work, gets the work, and is paid for the work. Willing, right, is seeking the work, is getting the work, and is paid for the work. Okay. What about unemployed population? It is that part of the population which is willing to work but is not getting the work. Right? Very sophisticated way to say this is the part of the population which is offering its skill sets, but the economy is not utilizing the skill set. That is basically employed as well as unemployed. So both of these are economically active, hence are counted as a part of labor force. Then there is non-workers. This is the part of the population which is not active economically. This is the part of the population which is not seeking work. On a lighter note, a lot of you people, right? A lot of you people, again, don't write it, don't take it seriously, by the way, right? So that's the reason I gave you a pretext, hashtag on a lighter note. That is, a lot of you would have simply said, let me quit my job. I don't want to work for the next 1 year. I will simply pursue UPSC civil services, which means you are not economically active. You have quit the rat race. Anyways, come back to the idea. Non-workers, not active economically, right? They are not searching for any kind of a job. For example, right, let's say the senior citizens, children below the age of 14 years, right? People who have quit, right, let's say job, and they are pursuing something else, etc. Everybody is okay, right? So population is divided into labor force as well as non-workers. Now, what are the different types of unemployments? Question can be asked on the types of unemployment. Please be very careful. Right, let's start. Frictional. When one person will quit the job and will join another job, but for some time will remain unemployed. Quit the job and join one more job, but for some time you will remain unemployed. That is called as frictional unemployment. Structural unemployment. Basically, there is a introduction of a new technology. With new technology, some of the skill sets of the workers becomes obsolete. Some of the skill sets become useless. They are not useful anymore. They will be losing the job. That is called as structural unemployment. So structural plus frictional, right, is also referred to as natural rate of unemployment. That is, any economy which is functioning normally I'm talking about. Obviously, there will be people switching one job to another, from one job to another. Obviously, companies will be adopting new type of a technology. So obviously, there will be creation of unemployment. That is natural rate of unemployment. Okay, natural rate of unemployment. Next, there is a cyclical rate of unemployment or cyclical unemployment. There is a, right, business cycle. One time the economy will be expanding, that is boom. After some time there will be stagnation, there will be slowdown, then there is a recovery. All of you have heard of this? Economic cycle or business cycle. Boom, right? The growth will get stagnated, then there is a slowdown, then there is a recession, then there is a recovery. This is a business cycle. So let's say economy enters into recession. Economy enters into, right, let's say recession. During recession, don't you think people will be losing their jobs? Unemployment will be created. That kind of unemployment is called as cyclical unemployment. Then there is a seasonal unemployment. From one season to another season, some of the sectors, some of the industries, their demand for the goods and services will either increase or decrease. For example, let's say agriculture. From one season to another season, after harvesting is over, there will be some, right, let's say time period when there is no requirement of a labor. So agriculture labor will be unemployed, right? Let's say the industries which are in the production of, let's say, ACs, industries which are in the production of, right, let's say cotton clothing, right, or the different types of garments, etc. So from one time period to another time period, according to the change of the season, some of the people might end up losing the job. That is called as seasonal unemployment. Then there is a disguised unemployment. You are hiring more than what is actually required. You are hiring more than what is actually required, right? In such cases, the number of people who are working is higher, but the productivity does not change. Best example, agriculture, right? That is a disguised unemployment. When the marginal productivity, change in the marginal productivity is zero, that is called as disguised unemployment. Then there is voluntary and open. What is the basic idea? Voluntary means you are not willing to work, right? Basically at the current wages. You don't want to work. That is called as voluntary. What about open unemployment? Open unemployment means person wants to work. Person wants to work, but jobs are not there in the market. Person wants to work, but the jobs are not there in the market. You are saying, right, I'm ready to work at this particular salary, but nobody's giving you, right, a job. You're saying whatever salary you're paying to others, pay me that only. Whatever is the prevailing salary, you give me that only. But nobody is giving you a job. That is called as open unemployment. Done? So these are the different types of unemployments. Please be very careful. Questions have been asked in the past in the prelims. Now, how do I measure, right? How do I measure employment, unemployment in India? Focus on whatever is applicable right now. The authorities, that is MOSPI, publishes, right, a report. This is PLFS, Periodic Labor Force Survey. Periodic Labor Force Survey. This particular PLFS was launched in 2017. This is published by, right, NSO. I said MOSPI. NSO functions under MOSPI. So this particular PLFS until recently was published quarterly. It was published once every quarter and it was published annually. But from this year, the government of India has changed the policy. Instead of publishing it quarterly, this is now being published monthly. Remember this as well. This is being published monthly now, right? Now, on what basis the data is collected and, right, let's say the calculation is done? Very simple. The most important activity status is CWS and US. Usual status and current weekly status. Meaning is simple. I don't expect UPSC to ask you the details, but anyways, usual status basically means were you employed for majority period of, right, last 1 year, or have you been employed in the last 30 days? That is usual status. Whereas under the current weekly status, the question will be, have you been working for at least 1 hour in the last 1 week? At least 1 hour in a day in the last 1 week, you are considered as employed. So this is how the survey is conducted and data is collected to calculate how much is the employment, how much is the unemployment, etc. Now the important ratios in the context of employment and unemployment, one is unemployment rate. What's a ratio? What is the total labor force, economically active population? Out of this economically active population, how many people are getting jobs? That is basically called as unemployment. How many people are not getting jobs? That is called as unemployment rate. Okay. Then there is worker population ratio. Total number of workers divided by total population. That will give you worker population ratio. Then there is a labor force participation rate as well. Right, that is total labor force divided by the working age population, that is 15 years to 59 years. Right, so these are the 3 different ratios that you are supposed to know. Please be aware of it. Go through this even one day before the exams, please go through this. They can ask you a straightforward factual based question or formula based question. Done? Okay. Next, industries. Next chapter, industries. Now within industries, what are the important points? Those are looking at the clock, don't worry. Right, couple of more concepts, we are going to complete the discussion. Do not panic. Within industries, what are the relevant points? What are the important points? Let's focus only on that. Let's start with definition of MSME. Important area. UPSC has the habit of asking a question on the definition of MSMEs. So what is the definition of MSME? Unlike earlier, where we had different definition for manufacturing MSMEs and service sector MSMEs, now Government of India uses two parameters: investment and turnover. Investment and turnover. So based on the investment and turnover, the government has the classification for micro, small and medium enterprises. So what are the parameters? Please memorize this: 2.5 and 10. This is the only number I generally remember. Why? I'll tell you the trick. 2.5 and 10, investment and turnover criteria. Multiply both of them 10 times. You will get the criteria for small industries, 25 and 100. And multiply this 5 times. Multiply this 5 times. Right? So you will get the definition for medium enterprises, 125 CR and 500 CR. Everybody is okay? My trick is this: if you have a better trick, please use it, because at the end of the day, what matters is, have you solved the question correctly or not? Right? Not whether you have used this trick or that trick, etc. At the end of the day, have you solved the question correctly or not is important. Okay, done. Right? So this is the definition. The Ministry of Micro, Small, Medium Enterprises was formed by Government of India in the year 2007. MSME Act first, then MSME. Okay, next, within industries, there are two indices by the way. One is Index of Industrial Production and the second one is Index of 8 Core Industries. I'm giving you this information, but I don't think UPSC will ask you this question. I'll tell you why. From 1st May, right, it was announced that the base year for both of them will change. The base year for both of them are going to change, right? The announcement has been done. It will come into force, right? So what are the important points? Let's look at only that, right? So Index of Industrial Production, it is published for every month by NSO, National Statistics Office, that is part of MOSPI, right? There are three main sectors under the IIP: electricity, mining and manufacturing, right? So these have been given the weightages, and the base year for the calculation of IIP is 2011 and 12, and the latest IIP that will come into publication after some time, it will have a base year of 22 and 23. The base year has been already changed. Okay. Then there is Index of 8 Core Industries. There are, right, let's say the sectors. There are 3 sectors. Within the 3 sectors, I will identify the most important 8 industries. I'll identify the most important 8 industries and I will calculate what is the change in the output. Right? So that is Index of 8 Core Industries, published by Office of Economic Advisor under the Ministry of Commerce. The base year right now, that is until now, was 11 and 12. It has been changed to 22 and 23. These are the 8 industries. My suggestion, please go through the list once before the exams, can be asked in the prelims. Refinery products, electricity, steel, coal, crude oil, natural gas, cement, fertilizer, right? These are the 8 industries. And the ICI will basically have 40.27% of the weight of IIP. That is, the industry wise, if you take individual weightages, get the sum total of all the 8 weightages, you get 40.27% of the 100% of IIP. Remember this particular number. Now, another important point within the industry is disinvestment. Disinvestment policy. What is the basic idea for disinvestment? Government selling the ownership. Very simple. Government selling the ownership. Right? Ownership in the entities which are owned by the Government of India. Now, the sale of the asset that is conducted by the government of India could be substantial. Substantial means wherein government of India will sell majority stake and will lose management control. Or it can be very minimal, right? Where government will sell the ownership but will still control management control or will have management control, etc. So what are the different methods through which the disinvestment is conducted? Strategic, entire or substantial, right, ownership is sold away by the government. Entire or substantial. But more importantly, whether you are selling more than 51% or more than 76% or let's say 100%, you are losing the management control. You're losing the management control. That's a basic idea. Okay. But extreme is 100%. 100% means completely privatized. Completely privatized. There can be minority stake sale as well. Minority means you're selling 2%. You're selling 5%. But more importantly, you are still owning at least 51% of the stake. At least 51% of the stake. Okay. Right. So minority, there are different types where you can go for minority stake sale. You can go for IPO. You can go for FPO. You can go for offer for sale. You can go for share buyback. You can even go for ETF methodologies. All of these are the different methodologies that are listed by DIPAM. All of you heard of DIPAM? Department of Investment and Public Asset Management, which functions under Ministry of Finance and which is responsible for disinvestment. Okay, now, whenever the government will conduct a disinvestment, money is collected. This money is kept into a fund which is called as a National Investment Fund. It is not a part of Consolidated Fund of India. I repeat, it is not a part of Consolidated Fund of India. It is a public account. The money from this is used by the government for specific purposes. For example, Government of India wants to invest in railway projects, capex in railway. Government of India wants to conduct, right, let's say, investments, right, in the banks, in the RRBs. The Government of India wants to purchase the shares in the rights issues done by the central public sector enterprises, etc. So there are specific reasons for which the Government of India will be withdrawing the money from the National Investment Fund. And the latest policy which has been announced by the Government of India regarding the disinvestment is the Central Public Sector Enterprises, the PSE policy in the year 2021. In fact, one question has been asked on this earlier as well, right, on this policy. That is, the Government of India has divided these particular CPSEs into strategic as well as non-strategic. Strategic as well as non-strategic. What's the basic idea? The government simply says, if these particular industries are important for national security, important for, right, achieving welfare, growth, etc., the government will have government will have maximum 4 units under this. Maximum 4. What if more than 4 are there? Government will merge them. For example, best example, banking sector. Right. On the other side, non-strategic. Non-strategic means these are not relevant. These are not important for the government for welfare, growth, national security, etc. For example, textile sector. So government simply says, in these particular sectors, government will not have any kind of ownership. Government will not have any kind of ownership. What if the units are already present? If the units are there, government will try to privatize them. If not possible, government will close them. That is a non-strategic sector. Done? Okay. The last part, last 5 or 8 minutes of today's discussion. This is planning, right? The most, or let's say the least important chapter. But anyways, in the planning, I'm expecting a question in this area. That is NITI Aayog. If at all a question has to be asked in the prelims, they might ask you about the, right, let's say the status of NITI Aayog, right, the origin of NITI Aayog, because it has completed 10 years. Or if they want to ask in the mains, they can ask you, right, evaluate to what extent NITI Aayog has been performing according to the objectives it has been set up with. So we will have a discussion later when we basically look at the mains discussion. But this is the last part. Planning as such is the least important topic in the whole Indian economy that you have covered. So before I continue the discussion, if you have liked this particular session, do not forget to hit the like button. And those who are worried about PDF, my dear, please don't panic. Let me complete the session. This PDF, I will upload in my official Telegram channel. In my Telegram channel, I'll upload it. You can download, but I want a commitment from your side, right? I want a payment from your side. What is a payment? Not in terms of monetary transaction, but in terms of a commitment saying that you will use it for revision purposes. You will not simply download it and keep it. You will use it for revision purposes, because hardly you will have around 15 pages. Hardly you will have around 15 pages, right? So 15 pages, you can simply sit in one shot and revise it within, let's say, 1.5 hours. So let's say Saturday, right? Or next Sunday. I'm saying no, Sunday though not possible, right? Let's say Saturday, you're already tensed, you want to revise Indian economy. But please, right, use these kind of short notes to revise it. Okay, done. So let me start now. Planning Commission. We had two authorities earlier, Planning Commission and National Development Council. Both of these particular authorities were set up through executive authority, executive order of the government. No law, not a constitutional, etc. Right? So Planning Commission, it was set up in 1950. Right? It was set up in 1950. It was set up through executive order of the government. The Planning Commission was chaired by the Prime Minister of India. But the most important authority within the Planning Commission was the vice chairperson or vice chairman. Earlier they used to use the term vice chairman. Now there is vice chairperson. Okay, right. So we implemented 12 5-year plans. The last 5-year plan, which was supposed to be implemented from 2012 to 2017, was discontinued, right? Was discontinued midway, that is in the 2015. That happened because the government replaced Planning Commission with one more authority, that is NITI Aayog. But in the context of planning, there is one more authority, National Development Council. It was set up in 1952, set up through executive order of the government. Here, right, important point, here that is basically the difference is, in the Planning Commission, there was no representation of the states. Whereas in the National Development Council, there was a representation of the states. Right? So representation of the states, right, was done in the National Development Council. It will also be, or it was also chaired by the Prime Minister. Done? Now, before I discuss the NITI Aayog, last point for today, here is a very important announcement. Those who joined later, those who have been late to the session, on Monday as well as Tuesday, I'll be taking special classes on the Unacademy platform where, right, we'll solve MCQs. On both the days, we'll solve MCQs. If we are not able to solve all the MCQs that I've already prepared for your benefit, I'll extend it to third day as well. But my suggestion in this particular week, focus on revision and MCQ. Revision, MCQ, revision and MCQ. Your focus should be only this. Don't read new material. Don't pick up a new book. Don't start reading a new book, etc. Done? Okay. Right. So these are the two QR codes. This is a QR code for the session on Monday, 4:30 p.m. And the second one is the QR code for Tuesday. Same 4:30 p.m. Both are special classes on the Unacademy platform. Now let me start. Share your Telegram ID. My dear, I don't have the QR code right now, but if you search Indian Economy for Exams by Shyam Shankar Kaggod, you will get a right Telegram channel. Anyways, let's go forward. NITI Aayog. NITI Aayog was set up in 2015 and it replaced the earlier Planning Commission. Now, under NITI Aayog, right, the focus is on promotion of cooperative federalism. The focus is on promoting competitive federalism. And more importantly, NITI Aayog basically, unlike Planning Commission, does not have, right, let's say powers in terms of finances. It cannot control, right, the powers in terms of finances, by the way. Okay. Right. So the different indices which are published, please focus on this. My guess is, if at all in the prelims a question is asked on NITI Aayog, they might ask you on one of these indices. I'll give a reason. Last year, all of you heard of what happened in Indore. All of you, I'm pretty sure all of you know what happened in Indore, the most cleanest city in India. There were, right, let's say, deaths because of, right, let's say, let's say, the water consumption, right, polluted water consumption. So in that context, NITI Aayog publishes an index called as Composite Water Management Index. Remember this. NITI Aayog publishes Composite Water Management Index. There is that index. There is also Export Preparedness Index, SDG India Index, Fiscal Health Index, Multi-Dimensional Poverty Index, Aspirational Districts Program. Right, so these are the important points. In addition to this, NITI Aayog, as usual, it is chaired by the Prime Minister. There is a participation of the states. Governing Council is there. Under the Governing Council, right, the chairperson is always the Prime Minister, by the way. Right, so there is a representation of the states as well under the Governing Council. Done? Right, so these are the things I wanted to discuss with you people, right? This is, right, the most, I should say, express way of revising the Indian economy in a span of 4 hours. Right, so we have started with the most important topic and we have kept on, right, petering down, going down to least important topics. And the last topic that we discussed was concept of planning, by the way. Right, so if you have liked the session, do not forget to hit the like button. If you're yet to join the Unacademy YouTube channel, please do it right now. Subscribe to the YouTube channel. And what is your feedback regarding the discussion that we have had in the last 4.5 hours? Please do let me know in the comment section of the video. Right, I generally go through the comments of the, right, let's say, the viewers regarding whatever has been discussed in my video. Right, so do let me know your feedback, right, in the video comment section. That's it from my side. I'll upload the PDF after some time. Please don't worry. You can download from the Telegram channel. That's it. Thank you. Have a great day. All the best to all of you.